Guys, we are live. I believe we are live. Can you all see me? Can you all hear me? Just confirm about audio and video. Can you all hear me and see me properly? Can you all hear me? Perfect. Audio video seems absolutely perfect. Okay. Now, just give me a second. Okay. So, hello everybody and welcome to this very important discussion video. Here we aim to sum up all the judicial updates, all the statutory updates, all the amendments that have come in your CA final direct access from May 25 attempt, for September 25 attempt, and for Jan 26 attempt. We aim to cover all those amendments as well which have come in your syllabus in Finance Act 2024. Every amendment that has come in past 1 year is summarized in this video. So if you are new to this channel, do like the video, do hit the subscribe button, and let's start. Maintain the high level of energy, maintain the superior energy with yourself, and just listen, just try to process down the things. And if you have any doubt, do not uh, do not have any issue in just messaging me down in the comment section. Now, perfect. So what all amendments that have come in Me 25. See, if you want the access of this PDF, I have already circulated this PDF on my Telegram channel. If you have not joined the Telegram channel till now, you can go click on the link given in description and you can have this PDF as well. Now, what all amendments have come in May 25 attempt? See, most of the amendments are already familiar to you, but these amendments are really important. These amendments might cause a difference of 15 to 20 marks if you are not aware about them. So just making you recall all the amendments. First of all, if you remember, sir, what was the tax rate for a domestic company? A domestic company was charged to tax at the rate of 25 oblique 30%. 25% was the rate applicable to those companies whose turnover in previous year 20 to 23 was up to 400 crore rupees. If you are one of the domestic company whose turnover in previous year 20 to 23 was 400 crore, then you were charged tax at the rate of 25%, else you were charged tax at the rate of 30%. Remember, previous year 20 to 23 is to be checked. Done, sir? Yes, sir. Sir, what if we had zero turnover in that year? Then 25% would still be applicable. It would mean that you have zero turnover in that year. Done, sir. Now, there was change in tax rate for a foreign company. Earlier, foreign company was charged to tax at the rate of 40%. Now, this has been reduced to 35%. Now, foreign companies charge to tax at the rate of 35% for your attempt as well. Now, what other amendments do we have? Section 115 BAB. Do you remember? If we had any manufacturing domestic companies who does manufacturing work, their manufacturing income was taxable at the rate of 15%. Now, provision says this section of 115 BAB is only applicable to those companies who commenced their operations before 31st March 2024. That means in your exam, if question comes for previous year 24-25 and company has commenced operation in 24-25 only, and remember, you would not get any benefit of this section. You will not be given any benefit of this section. Why it is so? Because your operations must have been commenced a year ago. Got this point, sir? Did you get this point? If you get this point, just mention clear again and again. It would boost my confidence and your confidence as well. Same thing applies for 115 BA. If you are one of the domestic manufacturing cooperative societies, domestic manufacturing cooperative societies, your manufacturing income was liable for 15% if you remember. But such benefit is only applicable if you had commenced your operations before 31st March 2024. It is important point to note, if operations have been commenced in previous year 24-25, you will not be given this benefit. This was important. If you miss out, maybe in some or the other MCQ, you might lose marks. Now, 115 BAC. See, people are often confused in 115 BAC tax rates. You must be very clear with this. For your attempt up to 3 lakh, we don't have any taxes. 3 lakh to 7 lakh, we have 5%. 7 lakh to 10 lakh, we have 10%. 10 lakh to 12 lakh, we have 15%. 12 lakh to 15 lakh, we have 20%. Or above 15 lakh, we have 30%. Simply, you can say this thing that whatever your income above 15 lakh is taxable at the rate of 30%, and income up to 15 lakh is 1 lakh 40,000 rupees is the taxes. You can write it in this manner as well. Are we clear with this point? Yes, sir. Now, whenever you intend to opt for 115 BAC, any SSC who pays tax under 115 BAC and he has a salary income, remember any salaried person is allowed deduction, standard deduction. Normally, standard deduction is 50,000 rupees, but if SSC opts under 115 BAC, he is allowed deduction of 75,000. This limit was earlier 50,000, but for 115 BAC, it has been increased to 75,000. Got this point? Could you can you recall this point? Yes, sir. Of course, we can recall this point. These were all the amendments in the basic chapters. Now we have amendment with respect to period of holding in capital gain. Remember, if any asset is held for 1, 2, 3 years, 1 year for some assets, 2 years for some assets, and 3 years for some assets. If assets have been held for more than the specified period, they were long term. If they were held for less than those specified period, they were short term. Now, what was the period of holding? This period of holding has undergone a change with effect from 23rd July 2024. This period of holding have undergone change. Now, what changes have been? So earlier what used to happen was any listed securities, any equity oriented mutual fund, any zero coupon bond and UTI. These were to be checked for 1 year. If they were held for more than 1 year, they were long term, else they were short term. Similarly, any unlisted shares, any immovable property were to be checked for 2 years. If they were held for 2 years, they were long term. If they were held for less than 2 years, then they were short term. Similarly, any other assets like gold, like debt oriented mutual funds, any other thing were to be checked for 3 years. If they were held for more than 3 years, they were long term. Otherwise, they were short term. Now, this was the case up to 23rd July 2024. Up to 23rd July 2024, this was the case. Now, what things have changed? After 23rd July, things have changed. Now, what government has done? Government says now there is no period of holding of 3 years as such. Every asset has to be checked for maximum 2 years. No 3 years of period of holding after 23rd July. In addition to that, any listed securities, there was others other than units of business trust. Now, this word has been removed, which implies earlier business trusts were checked for 3 years. Now they have to check. Now they are to be checked for 1 year only. Earlier, they were supposed to be checked for 3 years, but now they are to be checked for 1 year only. Got it? So, what things they have done? Earlier, we had 3 years, 2 years, 1 year period of holding before 23rd July. Now it is just 2 years and 1 year. Whatever the assets that were there for 3 years of period of holding have been reduced to 2 years, and business trusts which were earlier have to be held for 3 years now to be fetched for 1 year. Remember, to identify the period of holding, you have to see the date of transfer. Based on date of transfer only, you will be able to evaluate whether it is a long term or short term, whether old provisions to be checked or new provisions to be checked. It directly depends upon date of transfer. So date of transfer is very important. No. Section 47. What was amendment in section 47? If you remember, any gift given, remember I gave in class only, I gave one example in class that if somebody scores 85 plus marks, I will gift him my house. Provision says gift a taxation for somebody for a transferor is always exempt. Gift given by the transferor is always exempt. Any capital asset given as gift is always exempt for the transfer. But this exemption is only given to individual and HUF. Remember, if company gives any kinds of gift, it is taxable for company. If AOP, LLP, cooperative gives any kinds of gifts, it is taxable for them. This gift exemption is only for individuals and HUF. Got it, sir? Yes, sir. Now, what else do we have? Sir, we do have the benefit of indexation. If you remember, before 23rd July, 23rd July 2020, 23rd July 2024, if you used to sell any long-term capital asset and you had long-term capital gain, then cost of asset was taken as index cost of acquisition. Cost of improvement was taken as index cost of improvement. This was the provision before 23rd July. 23rd July before 23rd July we had this provision, but with effect from 23rd July 2024, we don't have concept of indexation. No indexation whatsoever. No indexation concept whatsoever. Whether it is any property, any asset, nothing, no indexation allowed. No indexation whatsoever. No indexation allowed at all. No indexation whatsoever. Got it, sir? Remember, for previous year 24-25, if in case you are asked to do indexation, then CII is 363. Almost it would be given in question, but if not, you must remember CII of this year, it is 363. Sir, very simple points these are. Very simple points these are. Sir, slum sale. What amendments were there in slum sales? Slum sale? Were there any amendments in slum sale? I will only tell if you like the video. If you have not liked the video now, Mata Rani will curse you, I'm telling you. Mata Rani will curse you. You will be about to reach the 10th floor of the building and all of a sudden your lift will stop. Remember, you will eat some mithai and there will be some salt in it. If you did not like the video, subscribe, hit the subscribe button. Now, what were the amendments in slum sale? Remember, see, slum sale is important with respect to period of holding. Why? Earlier, we had to check 3 years, 2 years, 1 year period of holding before 23rd July. After 23rd July, we had only 2 years and 1 year of period of holding. Whatever the assets were to be held for 3 years now are to be held for 2 years to make them long term. This thing has undergone change in case of slum sale. Remember, this thing had not undergone change in case of slum sale. For slum sale, even today you have to hold such unit for 3 years. You cannot use 2 years of period of holding. You should hold that unit for at least 3 years. Even today, period of holding has not changed for slum sale. You have to hold that unit for at least 3 years to make it long term. Otherwise, it would still become short term. Very important point from MCQ point of view. Now, 50 double A. If you remember 50 double A, 50 double A was a section where any securities that you would sell would render short term capital gain. Any securities, even if they are long-term capital assets, they would yield short-term capital gain. Whatever the gain you will arrive, it will be short-term capital gain only. It will never be long-term capital gain. Whatever the securities that are mentioned under 50 AA. Now, what were the securities mentioned under 50 AA? There were three securities. If you remember, there were market-linked debentures. There were specified mutual funds. In addition to that, with Finance Act 2024, new securities were entered. Sir, any unlisted bonds and debentures. If you have any kind of unlisted bonds and debentures and you transfer them, you redeem them after 23rd July, which are not listed now, they shall be computed in this section and whatever capital gain is arrived, it will be long-term capital gain. Remember, very important, very, very, very important from MCQ point of view. I personally think that MCQ is going to be asked from this topic. I personally think. What did I say? You have unlisted bonds and debentures maturing or redeem after 23rd July. After 23rd July, you are redeeming and maturing. Now, what would happen? It will always be short-term capital gain. You can never have long-term capital gain on these securities. It will always be short-term capital gain. If redeemed before 23rd July, it might become long-term, it might become short-term. It depends upon the case to case. But after 23rd July, it will always be short-term. Remember, ICAI does not apply these provisions to NR taxation. I don't know why, but these provisions ICAI do not apply to NR taxation. So in case if you are given anything about NR taxation and any short-term capital gain is earned by NR non-residents, if any short-term capital gain on or any of the bonds are being sold by a non-resident, they should render under 50 AA. They should be taxable under 50 AA, but I say never treats the same thing. So you must be aware about this fact as well. Now, what amendments have come? Amendments have come in tax rates. If you transfer any security referred under section 112A, that is, if you sell any kind of equity shares, equity oriented mutual funds, units of business trust, and you earn long term capital gain on that, remember, it is taxed at the rate of 10% up to 23rd July. And beyond 23rd July, it is taxed at 12.5%. Before 23rd July, it is taxed at 10%. After 23rd July, it is taxed at 12.5%. Over 1.25 lakh. Now remember, this 1.25 lakh limit is constant throughout. It is not separate for 23rd July before and 23rd July after. No, it is 125 lakh constant for entire year. 121 lakh 25,000 constant for entire year. First of all, your capital gain will be exhausted with this 1.25 lakh limit, and then whatever remains, whatever the amount remains, that will be first taxed at the rate of 10% depending upon date of sale, and then it will be taxed at the rate of 12.5%. Can you recall this? If you can recall this, then do smash the like button now. Similarly, when triple one, what does this section says? If you have any short-term capital gain on enlisted securities, equity-oriented mutual funds, or units of businesses, short-term capital gain, then earlier it was taxed at 10% before 23rd July, and with effect from 23rd July, it is being taxed at the rate of 20%. If you had any other STCG means you are selling property, you are selling bonds, and having short-term capital gain, then slab rate. Similarly, if you have LTCG under 112, it was earlier taxed at the rate of 20%, now it has been reduced to 12.5%. These are simple tax rates. Now, normally these are simple tax rates, but I want you all to focus on 112, 112, section 112. These are important. This is important. Why it is important? Let me tell you. Now, earlier, what provisions were? We had 20%. 20% with indexation benefit was given, but this has been reduced to 12.5%. Now, how things have changed, understand this. Earlier, if any resident individual, any assessee who used to sell any asset, they were charged to tax at the rate of 20% under 112, but indexation benefit was given. But if we had any non-resident foreign company investing in unlisted shares of Indian company, they were charged to 10% tax without indexation. This was before budget. In addition to that, if they had if anybody had any long-term capital gain on listed securities other than 112A, then they had an option of paying 10% or 20%, whichever is beneficial. 10% without taxation, 20% with taxation, whichever is beneficial. This was before budget. This was before 23rd July. After 23rd July, what changed? Everything was subsumed to 12.5% without indexation. Everything was subsumed. Earlier we had 20% for non-resident companies. Equity shares we had 10%. For other listed securities we had 10 oblique 20. But everything has changed to 12.5% now. But for individual and HUF, we have a benefit. Remember, if you are a resident individual or HUF, you are having a long-term capital gain on a immovable property which was acquired before 23rd July but sold thereafter. In that case, what would happen? In that case, what would happen? Provision says your tax would be calculated based on the lower of two. It will be either 20% with indexation and 12.5% without indexation. Remember, this benefit has been given to only resident individual HUFs, that too for long-term capital gain, and that too only for tax calculation. It is not for computation of capital gain, it is only for tax calculation. Remember, it is only for tax calculation, not the computational purpose. What this point? What did I say? What did I say? See, earlier there were 20% with indexation. Now it has been reduced to 12.5% without indexation. Remember, but for individual HUF, we still have an option to pay 20% with indexation or 12.5% without indexation, whichever is beneficial to us. This has been the entire summary of 112. Section 112. Very important section. I personally think that question might be asked from this topic. Done, sir? Yes, sir. Moving on to income from other sources. What were the amendments in income from other sources? Let's see. If you remember, if any company distributes any money on account of buyback, provision says whatever the money that has been received by the shareholders on account of buyback will be entirely deemed dividend. Deemed dividend referred under section 222F, 2 clause 22 subclause F. Remember, any money distributed by the company to the shareholders of the company will be buyback 222F. It will be considered. Got it, sir. Now, what about family pension? See how family pension was taxed. Normally, if I have a government employee at my home and he dies and I receive family pension on his behalf, provision says family pension will be taxable under IFOS. But such family pensions and section 57 deduction is allowed to us. How much deduction? Provision says one third of the family pension or 25,000, whichever is lower. This is only applicable to 115 BAC. If assessee opts out of 115 BAC, then what would happen? One third or 15,000, whichever is lower, would take place. This would give us the deduction amount, old regime. What I am saying is, if any assessee who earns family pension, first of all, will be taxed under IFOS. Second thing, he would get a deduction. How much deduction he would get? First of all, he would get deduction one third of the family pension or 25,000 under 115 BSc, or one third of family pension or 15,000 under old taxes. In this is the amount of benefit that they would get. Now, Section 57 allowable expenses and Section 58. What does it say? If you incur any expense to earn any IFRS income, if you earn any interest to earn any interest income, if you spend any other expenditure to earn any IFRS income, provision says it is allowed expenditure. If you have spent any sum to earn any IFRS income, normally it is allowed. But remember, whatever expenditure you have earned you incurred to earn the dividend under section 222F, that means if you have earned buyback dividend, any expenditure towards that buyback will not be allowed to you. If you have any dividend which is referred under section 222F, that is buyback, no expenditure would be allowed to you. No expenditure at all would be allowed to you against against that buyback income. Got it, sir. Now, what were the amendments in PGBP portion? See, normally PGBP didn't have much amendments. Let me tell you, there were only 2 or 3 minor amendments there that were there. First of all, if you are doing renting of house property, listen. Now, it might happen that you have a business of renting and not a business of renting. If you don't have a business of renting now, whatever income is will go to house property head. If I don't have a business of house property renting, whatever rental I would be receiving, that would go to house property only. But what if I have a business of renting? Then what would happen? See, if I am renting out residential house property, or I am renting out the commercial property, provision says if your business is of letting out the properties, then commercial properties let out would be taxable under PGBP. But residential house property letting out now would only be high house property only. Very important discussion. Very important discussion. If you let out any house property and your business is of letting out, income would not be always PGBP. Income would not be always PGBP. If your business is of letting out and you let out residential house property, it would still be considered as house property only. It would not be PGBP. Remember. Got it? Got it, G, got it. Yes, sir. Anna, we got it, sir. We got it. We got it. Now, what the next amendment was, sir, please tell. Before that, please like the video and also subscribe to the channel, please. Your small subscription motivates me a lot. Now, what it says now. If any employer contributes to NPS of employee, if any employer contributes to NPS of employee, now what happens in this case? If employer contributes, he is allowed a deduction. How much he is allowed such deduction? Provision says whatever actual contribution he does, or 14% of a salary. Earlier, this limit was 10%, but has been increased to 14%. 14% of the salary. Now, what does the salary amount means? Basic salary plus a dearness allowance. This is the amount of a deduction that he would get. Remember, earlier this was a 10%, now it has been increased to 14%. Now, what all amendments do we have? We have, see, for example, if I am being convicted, if I have been prosecuted, or against me any proceedings have been started under any act. For example, government thought that I have been contravening Sarfasi Act or any kind of FCRA Act. Then to settle the proceedings, if I am supposed to pay any amount, to settle the proceedings, if I'm supposed to pay any amount, provision says that would be considered as disallowed expenditure. If I pay any expenditure to settle the proceedings in contravention to any such law, that shall be disallowed. What all amendments do we have? Sir, we have amendment under 80cc2. I personally think this is very important section. Very important section, sir. What is this 80cc2? Now, if your employer contributes to your NPS, employer contributes to your national pension scheme. First of all, such contribution is taxable in your hands. That contribution is taxable in your hands, and you are allowed a deduction. First of all, it is taxable in your hands, and then you are allowed deduction on such contribution. How much deduction you are allowed? Sir, it depends upon the regime you are opting. If you are opting for 115 BAC, then whatever your actual employer's contribution is, that should be taken, or 14% of the salary, that is allowed as deduction under 80cc2. But if you are under old tax regime, if you are opting out of default tax regime now, then 10% or actual contribution will be given to you. But remember, under old tax regime also, if you are under a central government or state government employee, then instead of this 10%, 14% is given to you. What did I say? If you are opting for new tax regime, remember, you will be given deduction of 14% or actual contribution. But if you are opting for old tax regime, then you would be given deduction of 10% or actual contribution. But being a central government employee, you will get a 14% deduction. Got it, sir? Arey Baba, tell me, got it, ji, got it, sir. We got it. Under assessment of various entities, what amendments have come through? First of all, G, first amendment was in firm taxation. Now, what happens in a firm taxation? Sarji, if any of the firm pays any remuneration to the partners, now this limit was earlier different, and now this limit has changed. This is an important topic. Now, what is the limit? Provision says if your book profit, whatever the book profit is, takes first 6 lakhs of that book profit. First 6 lakhs of that book profit, you will be given 90% or 3 lakh, whichever is higher. 90% or 3 lakh, whichever is higher, you will be allowed as deduction for remuneration. But sir, what about balance book profit? Provision says balance book profit, you have to check the 60%. Now, for example, if I have 30 lakh of book profit, so first 6 lakh we would get 90%, or say 3 lakh, whichever is higher. That means 5.4 lakh we would get. On remaining 24 lakh, we would get 60%, which amounts to 14.4 lakh. So 14.4 plus that 19.8 lakh deduction you would get for remuneration. This is the change in case of remuneration. What all thing has changed? So in case of AOP, now what does that mean? Now, whenever you want to tax a AOP, mostly you will see that AOP is taxed at MMR only. Mostly, unless in one case AOP is taxed at MMR only. Now, what is MMR rate? I had made you learn by doing this 334, 3334, 334, 3334, 334, 3334. I had asked you to learn in this manner. So what does that mean? 334. Now 3 implies 30, 3 implies 37 plus 4 implies 4%. This was MMR. Similarly, 3 plus 2.5, that is 25 plus 4, this was also MMR. By default, this would be MMR rate, which implies to 39%. And if provision says assessee has opted out of default tax regime, he would be taxed at this rate. That means 42.744%. This would be surcharge rate if assessee opted out of default tax regime. Take a long breath. You are already aware about these amendments. I am just making you recall because these amendments are having greater testability to be asked in exam. Got it? Now, what about buyback? Sir, buyback. Before 30th September, buyback had different treatment. After 30th September, buyback had different treatment. Buyback has been asked multiple times now. What treatment was before 30th September? What the treatment was? Provision says. If any domestic company does buyback, Anna, listen, if any domestic company does the buyback, then it would be taxed in the hands of the company, and in the hands of the shareholder, it was exempt. Now, how taxation was taken happening in the hands of the company? Provision says whatever the distributed income that company used to distribute would be taxed at the rate of 20% plus 12% plus 4%. This was the amount of distributed income tax applicable in case of buyback. Whatever the buyback price minus issue price, this will be taxed at the rate of 20% plus 4%, 12% plus 4% in case of domestic company before 30th September. But in case of foreign company, what was the case? In the hands of company, it was not taxable, but in the hands of the shareholder, capital gain used to happen. This was the old provisions. Now government changed it entirely. Government entirely changed it. Government says any money received by the shareholders, any money received by the shareholders on account of buyback shall become deemed dividend. Any money received on account of buyback by the shareholder shall become deemed dividend. Remember, but there was certain exceptions to this point. Not exceptions actually, but there was certain benefit. Provision says whatever the cost of asset is for those shares that have been bought back will be given to you as short-term capital loss or long-term capital loss as the case may be. What I'm saying, if I have shares of say Reliance and company bought back those shares, then whatever money I am receiving on account of buyback, now it will be completely deemed dividend in my hands. But whatever the cost of asset that I had incurred for those shares, that would be given to me as short-term or long-term capital losses. It would be given to us. What all amendments have taken place? Sir, in case of business trust, small amendments have come. In case of business trust, small amendments have come. Now, what this business trust? See, normally whatever the capital gain rate change have taken place in for everybody, so business trust has also undergone such changes. For example, business trust has any long-term capital gain on any of the securities, then earlier it was 20%, then it was reduced to 12.5%. When business trust was selling any securities referred under triple one A, then earlier they were taxed at 20%, 15%. Now it has been increased to 20%. So whatever 112A changes have taken place, 112 triple one A changes have taken place, same changes would apply to business trust as well. Small change with respect to period of holding concept. Now listen, what this provision is all about. See, if you have any business trust units, if they were sold before 23rd July now, then period of holding were to be checked for 36 months, but after 23rd July, they have to be checked for 12 months. If they become long term, then what would happen? They were taxed at 10% over 1.25 lakh. After that, they were taxed at 12.5% before over 1.25 lakh. This was the case with business trust. If they become short term, then 15%. After 23rd July, it was 20%. This was the case with business trust. The period of holding has changed from 3 years to 1 year. Only change. Now, again, take a long breath, leave, another long breath, leave, come on to trust taxation. What this trust taxation is all about. What amendments have come in trust taxation? Only two or three minor amendments. What are those amendments? Try understanding this. Whenever trust received a provisional registration, now this provisional registration was to be converted into final registration. What was the due date, if I may tell you? What was the due date of converting this provisional registration into final registration? Let me tell you. Whatever the date we had, like, for example, uh, this is provisional registration date. We commenced the activities on this date, commenced the activities. We have to add 6 months to the date of commencement of the activities, and we have to reduce 6 months from the expiry of the provisional registration. Out of these two dates, whatever date comes earlier, we have to apply for final registration before these two. If you remember, this was the case. If you remember, this was the case. Provisional registration, activity commence, and expiry of registration. 6 months after commencement, 6 months prior to expiry of registration, whatever the date comes earlier, you have to apply for final within that period. That was the case. If you remember, this was the case. Now, earlier, what used to happen, whenever you used to apply for provisional converted into final, you were given final registration within 6 months from end of month of application. This was the case, but this has been changed. 6 months from the end of the quarter has been introduced. Then whatever quarter you are applying, let that quarter end, and within 6 months from the end of the quarter, you would be given final registration. Quarter word has been introduced. Similarly, if your registration is about to be expired, now for example, I have been given registration for 5 years, and that registration is going to expire very soon. Provision says at least 6 months prior you should apply for a fresh registration. Whenever you apply for fresh registration, now remember, you will be given registration within 6 months from the end of the quarter of application. Got it, sir? Third thing, what it says, if you are doing any modification in the objects of the trust, you have to apply for a fresh registration within 30 days. Whenever you apply for any fresh registration, now remember, you will be given fresh registration within 6 months from the end of the quarter of application. This is the amendment. In three cases, earlier it was 6 months from the end of the month, but it has been changed to 6 months from the end of the quarter. These were the three amendments. Small amendment. What happened was, see, whenever we used to go for any registration processes, we used to submit any form to CIT, PCITs. If we did delay even by 1 or 2 days, now because of genuine causes, also CIT, PCIT used to reject our application. Now, to give us a immunity, provision says if there is reasonable cause of delay, a CIT, PCIT has to condone this delay. Even if we are doing because of genuine causes, now it should be allowed to us now. So provision says if it is genuine cause of delay, CIT, PCIT would condone you for such delay. Now, section 1023C, what the amendments were in 1023C? What were the amendments? See, honestly, only small amendment. If you remember, what was 1023C? See, 1023C was a similar registration, similar process for 12AB. Everything was same, but under 1023C we have three different kinds of entity. First entity was entity which was wholly or part for substantially financed by the government. These entities were fully exempt and they were not required any registration. We also had different kind of schools, institutes, hospitals whose income were exempt and they were also not required registration if their total gross receipts were up to 5 crore, if you remember. These two people were not even required registration. These two people were fully exempt. Whatever the other people were under 1023C, they were required to get registration. Provision says we will not give any fresh registration to the institutes who apply after 1st October 2024. If you are any SSC who wants benefit of 1023C, then you have to apply it before 1st October 2024. After that, if you apply, we will not give you any registration. If you want to take benefit, go to 12AB. We will not give you 1023C. Also, if you are already registered, your benefits shall continue. But once your benefit expire, you have to switch on to 12AB. You will not be given any fresh registration under 1023C. Now, 194DA. What were the amendments in case of TDS, sir? There were amendments in TDS as well. There were many amendments in TDS. How can you forget? How can you even think of forgetting that? See, if any insurance company pay any money to any person on maturity, remember, if this maturity is taxable and maturity amount is greater than 1 lakh rupees, when provision says whatever the maturity minus premium amount is, TDS has to be deducted by this insurance company. How much TDS has to be deducted? Remember, if maturity minus premium amount is paid before 30th September 2024, then 5% TDS. If paid after or on or after 1st October, then 2% TDS rate. Remember, insurance company paying money to some resident person, then whatever the maturity amount is, my reduced by premium on that amount TDS would be deducted 5% or 2%, 5% or 2%, 5% before 30th September or 2% with effect from 1st October. This is the TDS rate. 194G, G for gambling. If any company pays any kind of commission on gambling or any kind of, I should say, lottery tickets, on any kind of sale of lottery tickets, then this company has to deduct 5% TDS on commission up to 30th September and 2% TDS with effect from 1st October on this lottery commission. Got it, G? 5%, 2% on 30th September, it has changed 5% or 2%. Now, under 194H, 5% was there, 5% was there before 30th September, and after 1st October, it went down, it went down to 2% in case of commission as well. There were multiple sections. 194I, there was no change. 194IA, now 194IE, IB, there were two changes. Now, what these sections were, let me tell you. First of all, if you buy any mall property, and the value of that property is more than 50 lakh rupees, or stamp duty value is more than 50 lakh rupees, whichever is higher, if it is more than 50 lakh rupees, na, then you are supposed to deduct a TDS at the rate of 1%. If value of the property or SDV of the property was more than 50 lakh, then you were supposed to deduct TDS at the rate of 1%. But amendment came. What amendment came? If you are buying the property, if you are buying the property, in three people are buying. For example, brother one is also buying the same property, brother two is also buying the same property, third brother is also buying the same property, but buying the same property only. Each is paying 25 lakh, 25 lakh, 25 lakh. Now, earlier TDS was not applicable on this transaction. Why TDS was not applicable? Simple being, because all of them are buying the same property now, and each buyer is paying less than 50 lakh rupees. So no TDS was applicable, but 194IA undergone changes, and it clearly stated that even if you buy property less than 50 lakh rupees, but collectively, if more than two buyers or if more than one buyer collectively buys more than 50 lakh rupees, then each buyer has to deduct TDS. So even though brother one's share is less than 50 lakh rupees, remember, if total share of the property, total value of the property exceeds 50 lakh, then each buyer has to deduct TDS. This was the minor amendment under 194IA. Same for 194IB. Provision says if somebody pays rent exceeding 50,000 rupees per month, then they are supposed to deduct TDS under 194IB. 5% up to 30th September and 2% with effect from 1st October. These were the changes. Now, what all sections were in which we had changes? See, we had changes in 194IB, we had 194M, we had 194G, we have 194H, we have 194O, we have 194DA. These are the sections in which we have changes in tax TDS rate. So you can remember IBM Ghoda. IBM Ghoda is the shortcut. You can even refer to this. I don't know who has created, but very, very, very well created. Now, 194M, 194N. Now, what does the section says? 194N. What does the section says? Remember, whenever you withdraw cash from, no, not in 194N, 194O. Now, this what 194O states. Listen, whenever you withdraw cash from bank, 194O is not cash withdrawal. For example, if we have e-commerce operator and this is seller, whenever this e-commerce seller pays any sum to e-commerce operator pays any sum to e-commerce seller, he has to deduct 1% TDS. 1% TDS is to be deducted, remember. But with effect from 1st October 2024, 0.1% TDS rate is applicable. Earlier it was 1%, but it has been reduced to 0.1% later on. Got it? Got it, G. Got it. 190 for a T. 190 for a T. What does this 190 for a T stats? Listen to this carefully. Listen to this carefully. What this 194 T stats, G? If any firm pays any interest, remuneration, bonus, commission to a partner with effect from 1st October 2000, 1st April 2025, this firm has to deduct a 10% TDS. 10% TDS has to be deducted. 10% TDS has to be deducted if aggregate payment exceeds 20,000 rupees. If aggregate payment exceeds 20,000 rupees, then TDS has to be deducted at the rate of 10%. Remember, this section is only applicable with effect from 1st October 2025. First thing. Second thing, even if you make the payment or you do the book entry, whatever the case is, you have to deduct TDS. Even if you make the payment or do book entry, TDS has to be deducted. Remember. Got it, G? Now, whenever you file a TDS return, earlier there was provision of revising it throughout the life. You can revise it any number of times, but now this has changed. Provision says if you have filed the return, you can revise it within 6 years from the end of the financial year. Once you file the return, let that financial year end, and within 6 years you can revise it. Beyond that, you cannot revise that return. Now, important provisions. Again, take a long breath. Now, come on to the provision. What does it says? If you have any kind of loss, if you have any kind of loss and you could not file return on time because of some genuine reasons, can you carry forward it? Right answer is ideally you cannot carry forward it, but there is an option through which you can carry forward. You can request a condonation to the authorities. Now, what is the authorities? Which authorities you can request condonation? That authorities have undergone changed. Earlier, whatever the provisions were, you have to completely ignore the earlier provisions. Right now, we have the new provisions. What are the new provisions? Provision says if your losses are up to 50 lakh rupees, no, sorry, if your losses are up to 1 crore rupees, then you have to go to CIT, PCIT. If your losses are more than 1 crore but up to 3 crore, then in that case, you have to go to CCIT. And if your losses are more than 3 crore rupees, then you have to go to PCCIT. Up to 1 crore CCIT, more than 1 crore, up to 3 crore CCIT, more than 3 crore PCCIT. This is the amount of losses that you must have to go to these respective authorities. Earlier, condonation was to be filed within 6 years, but now this has changed to 5 years. Now you have to go to you have to request condonation within 5 years. Small change in Aadhaar number. What does this small change is all about? Let me tell you. See, up to 1st October 2024, you were allowed Aadhaar number, and if you don't have Aadhaar number, then you could have simply given enrollment ID. You could have simply given enrollment ID and your documents were still valid. But with effect from 1st October 2024, no enrollment ID is to be furnished. You cannot furnish enrollment ID. You have to furnish the Aadhaar number only. You can only furnish Aadhaar number only. You cannot furnish enrollment ID. In addition to that, up to 31st December 2025, remember, up to 31st December 2025, wherever you had already mentioned enrollment ID, now you have to correct that enrollment ID and mention Aadhaar number. Remember, mention Aadhaar number. See, with effect from 1st October, you cannot, in 1st October 2024, you cannot even quote enrollment ID. Up to 31st December 2025, wherever you have quoted the enrollment ID, now you have to mention Aadhaar number there at that place. Section 144C, what the amendments are there in 144C. Provision says if there is a case of foreign company or non-resident, remember, foreign company or non-resident, draft order was to be given to the SSE, and SSE has the option to either object to DRP. Whenever there is a draft order, this draft order has to be given to SSE, and SSE has an option to object to this draft order and go to DRP. Now, in that case, this case is not available in case of search cases. If SSE has been under search or has been under requisition or is other party search, in that cases, this 144C draft order is not given to SSE. Whatever the order is, that will be final. No option to DRP is given to SSE. Now, amendments in income escaping assessment. Now, what amendments have been there? See, I personally believe that you have not studied the old income escaping assessment procedure. Whatever assessment procedure you have studied is new only. Whatever income escaping assessment is there, you have studied new only. Now, what the changes have taken place? Majorly, two or three changes have taken. First of all, earlier search cases were covered under income escaping assessment, requisition cases were covered under income escaping assessment, but they have been excluded from that regime, and they have been covered under block assessment. We will study block assessment, but remember, income escaping assessment are not sorry, it does not cover such cases right now. Second thing, what changes have been in income escaping assessment, sir? Major changes have been with respect to notices. Now, till when a notice or show cause notice can be issued? See, for show cause notice, you have to see if your income exceeds 50 lakh rupees, if your income escaped exceeds 50 lakh rupees, now, then within 5 years from the relevant assessment year, from the end of the relevant assessment year, you can be issued notice. But if your income is up to 50 lakh rupees or less, sorry, if your income is less than 50 lakh rupees, now, then within 3 years, you can be issued a show cause notice. If for issuing actual notice under 148, you have to see if income exceeds more than 50 lakh rupees or equal to 50 lakh rupees, then 5.3 years is the notice date. And talking about lesser than 50 lakh rupees, then 3.3 years is the notice date. So this notice date has been undergone too much of changes. Along with that, under income escaping assessment, earlier to issue notice and show cause notice, we used to have bigger authorities. But right now, bigger authorities have been reduced. This you only require approval of joint commissioner, joint director, additional commissioner, additional director. To do income escaping assessment, you require authority of these people only. That's it. That's it. That's it. That's it. These are the only changes in income escaping assessment. Now, demand order. Now, what this section is all about, it is important. Try understanding this. See, it might happen that in 2008 you filed return of income and there was some demand. Assessing officer sent the demand through the notice and you did not ever receive the notice. There was demand outstanding against you in 2008 and you did not even see what demand was because notice was lost. You did not ever receive the notice. Now, what has happened since 2008 till 2026? There has been too much of interest accumulated. Of course, your demand must have multiplied two or three times. It might happen that because of some reasons we might have not paid the demand, so interest might have been accumulated on that demand. It might be possible now. So provision says if interest has been accumulated on any of the demand, you can seek waiver of that interest. You can hold your hands together, request the IT authorities, and they can give you waiver of that interest. Now, whom you have to go, that is the important matter. Provision says if your interest is up to 50 lakh rupees, then you should go to CIT or PCIT. If your interest is above 50 lakh rupees but up to 1.5 crore, then you have to go to CCIT. And if your interest amount is more than 1.5 crore, then you have to go to PCCIT. Very important point. What I'm saying is 50 lakh rupees of interest, you can go to CIT, PCIT, they can condone. Then if your interest is more than 50 lakh but up to 1.5 crore, then you have to go to CCIT. If your interest is more than 1.5 crore, then you have to go to PCCIT for condonation of interest. Important point. Now we have block assessment. Now we have block assessment. Again, relax. Very simple point it is. Let's do it one by one. First of all, block assessment is only applicable in case of search, in case of a requisition, and in case of other party search. Now, what is other party search? For example, search has taken place at the premise of the Neha, and she has a box of documents, and in box of documents, my books, Rahul's books are found. My books are found at Neha's house. Provision says against me also proceedings of this block assessment would take place. This is other party search. Other party search, requisition, other party search. Now, and before understanding the search block assessment, we must understand some basic terminologies. First thing, what is a block period? What is a block period? Now, what is a block period? Listen. For example, it is previous at 24-25. On 1st December 2025, 24 search has been initiated at my house. And this search has been concluded on 10th December 2020. 1st December and it has been concluded on 10th December 2024. Now, always catch the conclusion of the search. Always catch the date of conclusion of the search. Whatever the previous year has been, that shall be your block period. In addition to that, six preceding previous year, that means previous year 23, 24, 22, 23, 21, 22, 20, 21, 19, 20, and 18, 19. These 6 years are our block period. Remember, 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 remember. These six preceding years plus year of search, these 6.8 years would constitute your block period. Remember, got this? Everybody clear with this point? What is a block period? What is block period? The year in which search took place, take that year from 1st April till the conclusion of the search. In addition to that, take preceding six previous years. This is called block period. Now your assessment for this entire block period would take place together. Entire block period would take place together. Now, how assessment would take place? For that matter, you need to know assessing officer is only going to tax the undisclosed income. Whatever the income that have been undisclosed for this 6 years, 6.8 years, assessing officer is going to tax that only. Remember, if there is any income which has not been disclosed, assessing officer is going to tax that only. In this block period, undisclosed income is only going to be taxed. That's it. Got it, sir. Sometimes what happens is, see, when do we say search is concluded? Provision says what the last day on which Panchnama is drawn is the date of conclusion of search. The last day on which Panchnama is drawn is the conclusion of the search. That's it. Telling you one or two, three things. Let me tell you. Now, what happens as soon as block assessment proceedings are initiated against me? As soon as block assessment proceedings are initiated against me, remember what happens. It might happen that 1 or 2 years out of these 6 years, 1 or 2 years are out of 6 years are already under assessment. It might happen now. An order has not been passed. It is possible now. Some scrutiny assessment, some income escaping assessment was already going on for this year, and an order has not been passed. It is possible. Now, provision says if any of the pending assessment is still pending now, that assessment shall abate. As soon as proceedings for block assessment has been started, your pending assessment shall abate. Abate means it will lose its value. It will lose its value. Assessing officer will not proceed with this assessment. Very important point. As soon as your block assessment starts, assessing officer is not going to proceed with this block assessment or proceed with any of the pending assessment. Now, for example, the order was passed. For example, 10 crore payable. 10 crore order payable was passed, and I went to CIT appeals. I was not satisfied with the search order, and I went to CIT appeals. I went to CIT appeals. I was not satisfied with the order, and CIT appeals gave order in my favor. CIT appeals gave order in my favor, and it reduced the demand to zero. Remember, all these assessments were abated, and block assessment was taken. And this block assessment 10 crore payable was literally quashed by the CIT appeals. Now, what would happen? Provision says, Asha Vaishnav, hello Vaishnav. Asha Vaishnav, I mean, what your name is? Asha. Hello. Okay. What the point is, if assessment that have been done at the time of block assessment has been set aside by CIT and all, then what would happen? Whatever the assessments that were abated during the initiation of this chapter, these shall revive. Revive. Wow. Now assessing officer will continue with these assessments. Now what will happen? Understand. What if, sir, department went to ITAT, and at department ITAT 1 at department and 10 crore is now payable. Provision says again this revived assessment shall abate again. This shall continue. What did I say? Try understanding this. What did I say? Try understanding this. If block assessment has been initiated, whatever the pending assessments were, that shall be stopped. That shall be stopped by the department. But if block assessment is set aside, this assessment shall again will start. If block assessment is again revived, this assessment shall lose its value. Again, what the bottom line is, whatever the block assessment is, that shall prevail. If block assessment is not prevailing, then other assessment shall prevail. That is the bottom line. Now, it might happen that my premise is under search. On 10th December, search has concluded. Within 6 months only, another search happened. Now, my earlier assessment was already undergoing, and Before the conclusion of the first assessment, there happened another assessment. Provision says it will have no impact. First of all, your first assessment would end. Your first assessment would end and order would be passed in case of first assessment. And whatever your second assessment is will initiate after the conclusion of the first assessment. Remember, this is the minor difference in case of block assessment. These were the basics. Now, what happens? What is the actual procedure between the search? What is the actual procedure during the search? Understand. We understood the basics. We understood what block period is. We understood what undisclosed income is. We understood what is the conclusion of the search. We understood how, if pending assessment is going on, then what would happen to our existing assessment. We understood every bit of it. Now, next question arises. Sir, department took away all of our assets. Department took away our books. Department took away our jewelry. Whatever the other assets were, whatever the valuable assets were, they took. Now, what they are going to do further? Listen to this point carefully. What department is going to do? Listen. Now, department will send us a notice, and in notice they would request us to file a return. Now, they took away the books. They will send a notice. I don't know how much time they are going to send, but it is not specified anywhere. But they will ask us to file the return within 60 days. Maximum 60 days they would give. From the date of notice till the filing of actual return, they would give us 60 days. And this return would be returned under section 158 BC. This is the return referred under 115 BC. It is important. 158 BC return is important. Now listen to this point very carefully. If you delay return even by 1 day, for example, you filed return on 61st day. Provision says from 61st day till the date of assessment order. Date of assessment order, you will be charged 1.5% interest per month or part of month for unpaid taxes. Got it? You will be charged to interest at the rate of 1.5% per month and part of the month from 61st day only. Sir, what if we file return of income on time? See, if you file return of income on time, no, it would be considered as 139 return under section 139. If you delay return, then it's up to department whether they want to take it or they would not take it. It is absolutely on them. If they would take it or they would not take it, it is absolutely on them. In addition, once you file the return under section under RY under 158 BC, now you have to declare whatever incomes you want to declare. You have to declare the incomes in this case. Now listen. Once you file the return, you will not be given any intimation under section 139, 141, 143, 1. You will not be given any intimation. No intimation is given. Will you get any notice under 148? No income escaping assessment notice is issued to us. Will we be able to revise this return? No, sir. Revision is also not possible. Once we file the return, assessing officer will collect information from third persons, will do other procedures. They might collect information from risk management strategy. They might collect information from our relatives. They might collect information from different SSCs and find out the total income and pass the final order. Remember, in this process, no draft order is given to SSC and DRP claim is allowed. No draft order or DRP is allowed. This is the entire process of search. Now listen, in this case, remember, who are the assessing officer? Joint commissioner, assistant commissioner, deputy commissioner, or ITO. ITO cannot do block assessment. ITO cannot do block assessments. Joint commissioner can do, yes, joint commissioner of course can do. Can ACDC do? They can do, but only if they are authorized by joint commissioner or they had a prior approval with the joint commissioner. Then only they can do the assessment. Otherwise, they cannot do assessment under this. These are the basics as to what happens after they take away your books. This is what happens. Now, how do they compute the total income of the block? Listen. Now, I personally think that this total income computation is difficult portion. Only thing understand is, see, we have an option to declare 158 BC. We have option to declare income under 158 BC. The incomes that we have not declared, we have to declare here. The incomes that we have not declared, we have to declare. For example, I declared 1 crore of income that was not declared anywhere. This is the undisclosed income. This will be taxed. In addition to that, In addition to that, like there might be some other income found by department which is not taxed earlier. It might happen, na? Whatever income I am myself saying that this is undeclared income, that would be income considered, that would be considered income. In addition to that, whatever the income that department himself finds out, provision says that shall also be considered. Both of this would be considered as income for the block period. This is the undisclosed income for the block period. This is the undisclosed income for the block period. Of course, we have to add certain other incomes that is not to be understood for now. We don't have to understand. We have studied that in full-fledged session, but right now we need to understand what is the undisclosed income which was not found earlier, income which was never disclosed earlier but has been disclosed right now in ROI. In addition to that, income that has been found by the department, we have never disclosed that. These two incomes are called undisclosed income. Now listen, on this income now, tax rate of 60% would apply. Tax rate of 60% would apply, and penalty at the rate of 50% of the taxes would apply. 50% of the taxes penalty would apply. Got it? Listen to small point. Listen to small point. Now, what happens? For example, this is the block period. This is the block period. It might happen that we have a losses of previous year 17-18. Can I set off this losses of 17-18 from this block income, from this loss income? Can I set off this losses against this block period? Right answer is no. I cannot set off. I cannot set off any losses from this block period income. From this undisclosed income, I'm not allowed to set off any losses. In addition to that, if firm is under taxation, for example, firm is under block period, remember, whatever the salary that has been paid, whatever the interest that has been paid, whatever the remuneration that has been paid, whatever the commission that has been paid to a non-working partner shall be excluded for computing the income under this provisions. Done, sir. Got this point. Done, sir. Absolutely got this point. In addition to that, last thing, sir, last thing. Telegram. Asha. Vaishnav, Telegram. What I was saying, okay. Now, for this block period, if any international transaction is found, international transaction for this period or for this period, provision says the year of search, whatever the international transaction that have been found for this period, for the year of search, no case would be referred to TPO. No case would be referred for transfer pricing. But if any international transaction have been found for these 6 years, now case would be referred to TPO and transfer pricing provision shall apply. Basic reason basic reason behind this is if any of the case has been found for this year, of course this assessee is yet to file return of for this year. Assessee is yet to file return of income for this year, so he will file return, and after that we would continue the proceedings. If any of the income has been identified, any of the international transactions have been identified for this year, provision says for this transfer pricing provision shall apply now. Transfer pricing provision shall apply. Provision says if any case is found, any of the case has to be referred to TPO. This case would be referred to TPO. This is all about your block period. Now, some other points. Listen. For example, conclusion of search took place on 10th December 2024. Now, assessing officer is bound to pass the order within a specified date. Now, what is that specified date? Provision says within 12 months from end of month. As soon as this month end now, that is 31st December, add 12 months to it, that means up to 31st December 2025, assessing officer is bound to pass the order. Assessing officer is bound to pass the assessment order in this case. But this was all about the block assessment. Listen, listen. During this intervening period, for example, there happened a court case. For example, court case. or for example court stay, or for example case has been has been transferred to board of advanced ruling, or for example case has been gone to valuation officer, or case has been gone to the other country under section 90. So whatever the time that has been lost is that would be given extra. In addition to that, if case has been referred to TPO now, then 12 months extra would be given in every case. This is the entire extensions as well. Remember, no interest under section 234 A, B, C would be charged. No penalty under section 270 A would be charged for the SSC who is covered under this block assessment. SSC would not even charge to penalty if he files a certain income in ROI. If he pays taxes on that, he evidence of tax is shown and appeal is not filed, then in that case, now whatever the penalty is being charged, the penalty of 50% would also be waived off. Penalty would be waived off. He just has to pay 60% taxes. Now, if other person is also under search, for example, as I said, Neha's books of accounts, Neha's premises were under search. Under books of accounts, Rahul's books are founded. So provision says Rahul will also undergo the same block assessment proceedings. This is what the entire point is. This is all about your block assessment. Are we clear with this point? Are we clear up to this point? Block assessment is very simple. You don't need to stretch it much. Whatever we have studied is sufficient. Whatever we have studied is sufficient. Now take again a deep breath. Come on to next point. Appeals and revisions. What does this appeals and revision imply? See, what are the amendments and appeals and revision? Remember, whenever you go to ITAT for appeals, earlier time limit was 60 days from the date of order. But now this limit has been changed. This limit has been changed, and the limit has changed to 2 months from end of month. As soon as your order month passes, 2 months from the end of the month is the date. 2 months from the end of the month is the date. You have to go to ITAT. Earlier it was 60 days, but it has been changed to 2 months from the end of the month. Now, what all changes have taken place in appeals and revisions? Listen to this point carefully. What happened is earlier when there was a case, it went to CIT appeals. Can CIT appeals say this case is not good? Assessing officer has not done good assessment. Can he refer back the case to AO for fresh assessment? Can CIT appeal? Does CIT appeal had this power to refer back to KO for fresh assessment? Whether CIT appeals had this power? Right answer is no. CIT appeals did not have this power to refer the case back to AO for fresh assessment. Whether ITAT had this power? Yes, ITAT had this power. ITAT had this power to refer back a case to AO for fresh assessment. ITAT had this power. But now my question is, now amendment is, provision says CIT appeal can also refer back to AO for fresh assessment only under section 144. If assessment is pending with respect to block period, sorry, block name for best judgment assessment. If any best judgment assessment case has been transferred to CIT appeals can refer back this case to assessing officer for fresh assessment. Important point. Normally, CIT appeals, Joint Commission appeals doesn't have power to refer the case back to assessing officer for fresh assessment. In case of 144, in case of best judgment assessment, CIT appeals can refer back the case back to AO. Special provisions by the appeal by the department. What does this point says now? If department wants to go to appeal, see, department should be given a monetary limit. Otherwise, they would go to appeal for even smaller amounts. So for that matter now, CBDT has fixed on certain limits beyond which department can only go to appeal. For example, if department wants to go to appeal to ITAT, remember 60 lakh is the tax effect below which department cannot go to ITAT. 60 lakh is the time limit below which department cannot go to ITT. Sir, for example, if they want to go to I Court, they have to have at least 2 crore of the 2 crores should be the tax effect. If they want to go to Supreme Court, tax effect should be more than 5 crore. This is what the monetary limit is below which department cannot go to ITT or High Court or Supreme Court in case. Now, another important point. What is tax effect? Remember, this is important point. What is tax effect? Remember. Now, whenever outstanding tax, say for example, is 58 lakh, plus interest is 4 lakh, plus penalty is 3 lakh. Tax turns out to be say 65 lakh. Provision says this is not to be checked. Only the tax amount is to be checked. No interest, no penalty, no late fees is to be checked for the purpose of 60 lakh, 2 crore, 5 crore limit. Only the actually paid tax has to be checked to find out the limit. Only actually paid tax has to be checked. Under black money law, what were the amendments? Try understanding this. See, earlier what used to happen, if any of the undisclosed foreign assets were found, undisclosed foreign assets were found. Okay, for example, Rahul had undisclosed foreign asset. Now, whatever the undisclosed foreign assets were now, I were charged 30% taxes on this undisclosed foreign assets and three times penalty. Three times penalty on this undisclosed foreign asset. Three times penalty on this undisclosed foreign assets I was charged. Now, provision says, provision says on this undisclosed foreign asset, I was charged 30% taxes and three times penalty. But department gave a benefit to small people. Provision says if you have undisclosed foreign assets up to 20 lakh rupees, then only taxes you have to pay, you don't have to pay the penalty. If you have only up to 20 lakh rupees in the undisclosed assets, it's okay. Do not pay the penalty, just pay the taxes. But sir, but if you have any immovable property, now any immovable property as foreign assets, then no benefit is given. That means 20 lakh benefit is given to every asset except for immovable property. If you have any asset abroad except for immovable property up to 20 lakh rupees, no penalty is to be paid. But if you have any kind of immovable property outside, then you have to declare it even if you have a rupee property outside India. Got this point? Got this point. No penalty shall be levied if failure is on account of undisclosed foreign asset up to 20 lakh rupees. Other than immovable property, this benefit is not given to immovable properties. Section 44 BBC. What does the section says? Listen. For example, if there is a cruise shipping business in India, cruise shipping business. Now, what is this cruise shipping business? Provision says any kind of entity which operates for leisure purposes. Now, what is cruise shipping? We will discuss it later on. But cruise shipping business has a mandatory option. Had a mandatory task. We have to declare 20% of their receipts as PGBP. Whatever they receive on account of Indian people or whatever they receive on account of people carrying to India, whatever money received or receivable is, whatever the money received or receivable is for the people for the purpose of cruise purposes, out of that 20% has to be declared as PGP in India. Can they declare lower than this 20%? Right answer is no. They cannot declare lower than 20%. Can they maintain books of accounts and do audit, get their books of accounts audited? Right answer is no. Minimum 20% they have to declare. They don't have a choice in this case at all. What are the amendments, sir, in case of NRI taxation? NRI taxation, sir, what are the NRIs? Listen. If we have any non-NRI, NRI implies any kind of non-resident, but he is an Indian citizen. He is an Indian citizen, but a non-resident. He is called NRI. Now, what happens in case of NRI? What happens? If NRI has forex asset. On this forex asset, if they have long-term capital gain, a long-term capital gain is taxed at the rate of 10% before 23rd July, and this was later on increased to 12.5% after 23rd July. But other assets, if they have, they would be taxed at normal provisions of income tax act. Got it, G? This is simple provisions with NRI. Remember, if NRI go for this benefit, if NRI go for this benefit of foreign forex asset, remember, no 1.25 lakh benefit would be given even if they sell listed securities. See, forex asset can be listed equity shares as well. Forex asset can be listed equity shares as well. Even on listed equity shares, they would not get any benefit of 1.25 lakh. But, but if they do not opt for this, they would go regular provision. They would go as per regular provisions. They would go as per regular provisions. Got it, G? Sir, we absolutely got it. Sir, what is about FII taxation? How FII taxation takes place? Understand this thing. If FIIs have long-term capital gain under section 112A, then in excess of 1.25 lakh, they were taxed at 10% before 20th July, and after 20th July, they were taxed at 12.5%. Other LTCG, remember, other LTCG is 10% only. It has not been increased to 12.5. No, 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 it is 10% only. Other LTCG is 10% only. For Jan-26, other LTCG, whatever bonds, whatever immovable properties, whatever FIIs earn other than 112A would be taxed at 10% only. And this is correct. This is absolutely correct. If FIIs are short-term capital gain referred under section 111A, then 15% oblique 20% is the tax rate. Other SEC would be taxed at 30%. Other SEC would be taxed at 30%. Interest and dividend. If FII earn any interest or dividend, it would be taxed at 20%. A specified fund earns any interest dividend, it would be taxed at 10%. RDB is to be cut. Only 10-20% is the tax rate for any income for FIIs. Similarly, for OFO, if we have other offshore financial organizations, if they have any long-term capital gain on mutual funds, 10% oblique 12.5% is to be charged before 23rd July and after 23rd July. This is the tax rate. Taxation of GDR. Similarly, if any non-resident has any capital gain on GDR, provision is 10% or 12.5% is the tax rate applicable. That's it. That's it. That's the entire amendments in our taxation. Last amendment applicable for May 25, that was part of May 25 amendments. That was transfer pricing officer. See, if any case has been referred to TPO and he finds any international transaction, he can cover such international transaction also for the purpose of determining arm's length price. But if he finds out any specified domestic transaction, he can even cover that specified domestic transfer pricing, specified domestic transaction as well for his proceedings. He can cover that transaction price as well. These were the amendments applicable for May 25. Anybody having any doubt up to this point? Anybody having any doubt up to this point, in this point, till this point? No, sir. No, sir. No, sir. No, sir. No doubt. Moving on to amendments applicable for September 25. Listen one by one. Listen one by one. For example, this is Rahul. If any assessee pays any interest, commission, and many other payments to a unit located in IFSC, provision says no TDS is to be deducted. Why? Because IFSC unit would be opting for 80 LA now. So for 10 consecutive years, every income of IFSC would be zero. No income of IFSC would be taxable now. For 10 years, it would not be taxable now. Logically, logically think. No income of IFSC would be taxable. For 10 years, no income of IFSC would be taxable. So why would we deduct TDS? Provision says no TDS. In addition to that, second point. Second point, what it says. For example, if we have IFSC and we have a bank in IFSC, and if we have a non-resident, if non-resident had deposited certain money in a bank in IFSC and this bank is paying out the interest, provision says no TDS on this interest. If this money had been given after 1st April 2005, then in that case no interest is to be paid. Sorry, no TDS is to be deducted on interest component. No TDS on this interest component. Very simple point, sir. In addition, now listen, if you remember section 194N, do you remember 194N? What was 194N? If you remember, whenever you withdraw any money from bank up to 1 crore, no TDS is applicable, but beyond 1 crore, 2% TDS is applicable. Yes, if you remember, 1 crore, no TDS, up to 2, beyond 1 crore, 2% TDS was applicable, if you remember. Now, in this series only, there were certain exemptions. If you remember, if government used to withdraw money, if government withdrew money, then no TDS was applicable. If banks withdrew money, no TDS was applicable. If Agriculture Market Produce Committee member used to withdraw money, then no TDS was applicable. Listen, do you remember this? In that list only, some people were added. What are those some people? Sir, UN bodies, if we have any UN bodies in India, if they withdraw money, no TDS is applicable under 194N. If any foreign consulate withdraws any money, no TDS is applicable. This is the entire discussion. These two people have been added under the list of 194N. Now, if you remember, there was section 196 under TDS chapter. What was section 196? Whenever you make payment to government, whenever you make payment to a statutory corporation, whenever you make payment to any kind of, say, mutual fund, no TDS under any section. No TDS under any section is applicable. If you remember, this was the case. No TDS under any section was applicable. Now, in that list only, a name is added, which is Credit Guarantee Trust Fund. In that list only, a name is added, that is Credit Guarantee Trust Fund. No TDS is deducted whenever we pay any sum to this Credit Guarantee Trust Fund. Now, if you remember, there was section 206C1F. What was that section? If you buy any motor car, or if you sell any motor car, you have to collect a TCS at the rate of 1%. You have to collect a TCS at the rate of 1% from whom you are selling. Remember that, but that buyer should not be any motor vehicle dealer, but you have to collect a TCS at the rate of 1%, if you remember. Section 206C1F mandates collection of TCS at the rate of 1% if you are selling any motor vehicle exceeding 10 lakh rupees. If you remember, this was the case. But in that list, certain few more items have been added. Now, what's that list? Listen. If you sell right now, if you sell any shoes whose worth exceeds 10 lakh rupees, if you sell shoes of Messi, Lionel Messi, then 1% TCS has to be collected. If you sell any kind of wristwatch exceeding 10 lakh rupees, for example, Rolex wristwatch you are selling, then 1% TCS to be collected. If you sell any kind of art piece, antiques, paintings, then TCS 1% has to be collected. Sunglasses. If you sell any sunglasses exceeding 10 lakh rupees, then 1% TCS has to be collected. Purses, handbags, then 1% is to be collected. Coins, stamps, collectible items, in that case, 1% is to be collected. If you sell any sportswear, sports equipments, then 1% is to be collected, exceeding, of course, 10 lakh rupees. If you sell any horse which is used for horse racing, then 1% is to be collected. If you sell any yacht, rowing boats, or helicopter, then 1% is to be collected in all these cases. All these cases. Now, in non-resident taxation in September 25, small change came. What it said, if you remember, 44 BBC was the entity, was the presumptive taxation for cruise shipping companies. Cruise shipping companies. This was the presumptive taxation for cruise shipping companies. Now, what is a cruise shipping company? Provision says if there is any ship which is having capacity of more than 2%, which is having more than 200 passengers. First of all, passengers have to be more than 200. Then second thing, this ship shall cover at least two of India's port. Mumbai port, Goa port, Vishakhapatnam port, Kolkata port, at least two port it should cover. At least two Indian ports it should cover. And third thing, such ship must be for leisure purposes. That should not hold cargo at all. It should be leisure purposes, then only it will be specified person. Another small change came in case of NR taxation. What happened was, if there is a foreign company who has a license office in India. Now, what is license office? License office is office where they do not have any operations going on. That is just office for inquiry purposes, office just for marketing purposes, but no business happen in that place. Provision says if they have any license office now. This license office was earlier under no guidelines were issued, no requirements was for reporting was done on this license offices. Now, government mandated certain guidelines. Now, what government mandated? Understand. Government said this license office has to furnish Form 2049C. Whatever the transactions that they had done during the year, whatever the transactions they had done during the year, they have to furnish these transactions under 49C. When they have to submit, listen, financial year ends, end of the financial year, that is 31st March. Let 8 months end. 8 months, that means 30th November. Within up to 30th November, they have to furnish this statement, and in that statement, they have to tell the transactions that they have entered. 49C, license office of a foreign company. 92 CB. Under September 25 statutory updates, there was a small amendment with respect to transfer pricing. Now, if you remember, there was section 92 CB. 92 CB was about safe harbor rules, if you remember. Provision says government might come up with safe harbor rules to ease down the transfer pricing process. And government did come up. Government came up with one transfer pricing rule. What government came up? Government came up with 92 CB. And what government did? Listen. Government said if there is an assessee who is a foreign company, which is into diamond mining, and it sells any kind of uncut, unpolished, unassorted diamonds into special notified zones. Then whatever the money received is and whatever the money receivable is, we'll add that, and this foreign company has to declare 4% as PGBP. This is not the tax rate, this is the PGBP. This is the amount of income they should be declaring, and 35% would be tax rate. So foreign company into uncut, unassorted diamonds display business, it would not display business, but uncut, unassorted diamond sale business, it would be safe harbor rules would be applicable. They have to declare 4% as the PGBP. Remember, there was similar provisions under business connection as well. If they had foreign company who is into diamond mining business, it did uncut, unassorted, unpolished diamonds, not the sales, but a business, but a display activity. Provision says whenever there is display activity happening now, it does not amount to business connection. It would not be taxable in India. But if they are actually selling the diamonds now, then in that case, safe harbor rules would be applicable. Safe harbor rules would be applicable. Got it? Provision says whenever safe harbor rules uh, have been used by the entity, provision says in that case, no reference to no ALP would come into picture, arm's length price calculation, no TPO would come into picture, no calculation of ALP would take place. Anything would not be taking place if SSC declares 4% income. Remember, whenever you declare 4%, now you are not given deduction of any expenditure. For example, you want to claim depreciation, no, you are not allowed. WTV shall reduce notionally. Remember, whatever, if you declare 4% and if you have losses in any of the previous year, provision says you cannot set off losses against this 4%. Yeah, we are asking only 4% of your PGBP. Do you think that government will allow losses also? Right answer is no. Documentation under 92D, what it says. If you are opting for safe harbor rules, you still have to maintain the documentation. You have to get your books of accounts audited and audit under section 92E. Remember, whenever you want to go for safe harbor rules, you have to furnish form 3 CEFC to claim the benefit of safe harbor rules. In case you do not furnish, you will be covered under regular provisions. In case AO feels that you are misusing the provisions of safe harbor rules, now you are claiming you are giving wrong declaration or you have furnished incorrect information, assessing officer would declare such safe harbor rules as void ab initio. In case of safe harbor rules, no MAP is allowed. Now, what is MAP? Listen. If you want two countries to come together and talk about some transaction, this process is called mutual agreement procedure. Provision says two countries would not talk if you are opting safe harbor rules. Two countries would not come up together and talking because government has already notified. So government people employees could not come together to talk about this transaction. No two countries would talk about this transaction that are covered under safe harbor rules. If you remember, if any of the Indian entity pays any sum to non-resident associate enterprise in the form of interest, then if you remember 94B comes into picture and whatever interest we pay up to 30% of EBITDA is only allowed. If you remember 30% of the EBITDA is only allowed. In that list only provision say government said if there is a unit located in IFSC, which is a finance unit, provision says if this finance unit pays any sum, if this finance unit pays any sum to any of the non-resident associate enterprise, na, then 30% of EBITDA would not apply. 30% of EBITDA would not apply. This is what the entire point. Got it? Now we have compounding offense. I want you all to focus for at least the next 5 to 7 minutes, for very carefully, very seriously. I want you all to listen. What I'll be speaking for next 5 to 10 minutes. You have to be very careful enough. What I'm saying. Whenever you commit any crime, whenever you do any default in income tax, you are penalized for that. But not just penalized. There is prosecution initiated against you. And later on, you might be convicted and you can be sentenced to jail. That happens. This is the bottom line. What I'm saying, whenever you commit any crime in income tax, you might be prosecuted. You will be charged penalty. You will also you will also be your prosecution would also start against you, and you might be convicted. You might be even convicted later on. Guru Ji Harsha. Now, what I'm saying is, it is Hindi Harsha. It is English Harsha. Now, whenever you commit crime, penalty is leviable. After penalty, prosecution starts. If prosecution is completed, you are convicted. You are convicted. You will be levied. You can be sentenced to jail. Now, what is this compounding? Compounding implies I am dropping down the prosecution's proceedings. I don't want to fight for prosecution. I'm just paying you money. Do not prosecute me. That is the only point of compounding. I don't want to get into jail. I don't want to get into the compliance purposes. Just to take the money from me, and I don't want to do anything. I don't want to go to jail. What I am saying is, what is compounding? You just have to pay the money and drop down the proceedings. That's it. To drop down the proceedings of prosecution, you just pay the money, and that's the compounding. Got it? Now, during prosecution, you have to pay. Sorry, during compounding, you have to pay three monies. Listen, three types of monies to be paid. First of all, is the actual taxes you have committed default in any of the section of the Income Tax Act. Then you have to pay taxes as per that section. You have to pay interest, you have to pay surcharge, you have to pay penalty as well. These things are to be paid before compounding. Always these things are to be paid. Before paying these things, you will never be given compounding, or you will not be rescuing you. No prosecution will be dropped. You have to pay taxes first. This is first thing to be paid. Second thing that is to be paid is application money. Whenever you apply for compounding, you have to pay some application money. I will tell you what how much amount of application money to be paid. Third thing you have to pay is compounding fees. Three things are to be paid. Now, whenever compounding happen as per section. For example, if I have done any kind of default under section 276B, for example, I have not filed return, willfully not filed return, I have willfully not deducted TDS. There are specific sections as to under which section I am guilty. There are specific sections. So I have to see compounding for every section separately. If I am guilty under 8 sections now, I have to pay compounding fees for eight different sections, 8 different times I have to pay. If I am guilty under one section, I have to pay compounding fees once. So whatever number of mistakes that I have done, whatever the mistakes, whatever number of sections on which I am guilty, I have to pay compounding fees that number of years. Listen, in addition to that, if I commit that offense multiple times, I have to pay the compounding fees. Got it? Got it? Now, how compounding takes place, I'll tell you the process. I'll take you through the question answer, and then I will take you through the summary. Understand it one by one. See, everything is important because everything is important with from 1st October 2024. What does that mean? See, compounding is not a new concept. Compounding is a very old concept. But on 17th October 2024, new guidelines with respect to compounding came. And what are the benefits of these guidelines? See, under these new guidelines, every offense is a compoundable offense, right? Earlier certain offenses were not compoundable. But right now, every offense is compoundable offense. Therefore, from 17th October 2024, certain things have changed. Now, how certain things have changed? Understand this. Earlier also, compounding was applicable. We used to file compounding applications as well. Provision says if any of the compounding application has already been filed under old guidelines, it shall continue valid. It shall be valid. If any of the application has been filed in old guidelines and it is pending and new guidelines have come, you don't have to file a fresh application. Whatever the existing application that you have already filed now will be considered as first application in this compound as in this new guidelines. So if you have already filed application in old guidelines, so you don't have to freshly file a new application. Old application is still valid. But what if you had filed application in the old guidelines and that application has been rejected then and therein? Application has been rejected therein. Provision says if application has been rejected therein, then new guidelines, new application can be filed. New application can be filed in new guidelines. What did I say? Listen. If your application was pending in old guidelines, that shall be continued, that shall continue. You don't have to do anything to the new, you don't have to do anything as new application. But if that application was rejected in old guidelines, then what you have to do? You have to file a fresh application under new guidelines. You will be allowed compounding. Now, to whom you have to file the compounding? You have to file compounding. You have to request compounding to jurisdictional CCIT, DGIT, PCCIT, and PGDIT. You have to go for these two. You have to go to these four people for compounding purposes. Listen, how compounding is done. See, it might happen that you have committed offense under one section only. So you can file a single application. Or if you have been prosecuted under multiple sections, you can club all the applications and file a consolidated application. Now, how much fees is to be paid? Understand. If you go single application, then 25,000. But if you have committed multiple offenses and you want to file a consolidated application, then 50,000 fees. Remember, whatever the application fees is not refundable, but it is adjustable. What did I say? What did I say? Try understanding this. Try understanding this. Whenever we want compounding, we have to pay three monies. First of all is the tax money on which we have been prosecuted. Interest and penalty money we have to pay it. Second thing we have to pay is, sir, application money. If we are filing the single application for a single offense, then application money is 25,000. But if we are collating, we are combining multiple offenses together, in that case what would happen? In that case, 50,000 would be the application money. Well, listen, compounding of an offense is only allowed when you pay relevant taxes and surcharge. Okay? No, every offense in income tax right now is compoundable. Earlier provisions were different, but right now every offense in income tax is compoundable. How procedure take place? Listen, if whenever assessee wants to go for compounding, he has to file application to CCIT, PDGIT, PCCIT, and PDGIT. CCIT, DGIT, PCCIT, PDGIT. He has to file this application to these four people. Listen. These four big people would transfer the case to assessing assistant director, deputy director, and these assistant director, deputy director would request the assessee to pay the compounding fees. Whatever the compounding fees are, they would request assessee to pay the compounding fees. Assessee has to pay the compounding fees within 1 month from the end of the month of intimation. This is the duty of the assessee. Pay the compounding fees. If assessee is not able to pay within 1 year, he can seek the extension. 6 month extension can be given by a competent authority. If he wants more extension, then 6 months to 12-month extension would be given. If he wants extension for more than 12 months, up to 24 months, then CBDT chairperson is required. If more than 24 months, then no compounding, no extension is allowed. If compounding charges are not paid, application is absolutely rejected and prosecution shall continue. Now, what entire thing I have told you is, first of all, compounding is sought section wise. If you have committed crime under one section or a default under one section, that section has to be separately gone. Second section has to be separately compounded. Third section has to be separately compounded. You can file a single application for each section, or you can club all these sections and you can file a consolidated application. Whenever you file consolidated application, your application goes to CCIT, PCCIT, PDGIT, DGIT. Your application goes to these people. These people will refer the case to ADD. Remember, ADDD, Assistant Director, Deputy Director. Now, Assistant Director and Deputy Director will ask you to pay the relevant compounding charges, and you have to pay that charges within 1 month. If not 1 month, then 6 month extension, 12-month extension, 24 per month extension, but not beyond 24-month extension you will be given. That's it. Now, how much compounding charges are to be paid? That is important. Listen now. For example, for a specific year, I have committed default under 276B. I want compounding for that section. I have to pay a charges that is given in question. Normally, compounding charges are given in question. It might happen that in Indore you have to pay 80,000 as compounding charges, but in Chennai you have to pay 1 lakh for the same charge. It might happen. So compounding charges may differ. Compounding charges are not same. Whatever the compounding charges are would be given to you in the question. Now, what the matter is, once you commit default under a specific section, for example 276B, you have to pay compounding charges. Say compounding charges are 50,000. Next time when you commit the same default now, you have to pay 1.2 times of the compounding charges. That means 60,000 you have to pay. Third time if you do the same offense under the same section, then 1.4 times compounding charges are to be paid. Fourth time if you do the compound mistake, now then 1.6 times charges are to be charged. Fifth time if you do the same mistake, now then 1.8 times compounding charges, and this would go on continuously. Every time you default in the same section, your compounding charges would increase every year. Your compounding charges would increase every year. And that is what makes this portion more trickier one. Understand this. Your compounding charges are normally fixed, but if you do the same offense repeatedly, then your compounding charges would increase. And also, listen, if you commit an offense, you have your prosecution have been initiated, and after 12 months you are going for compounding. Now provision says whatever your compounding charges are into 1.2, 1.4, 1.6, whatever the case is, in addition to that you have to pay 50% extra. Now let's try to solve it with the example given in notes. Then we will solve one question of RTP, and at last we will solve, and at last we will do the summarize things. Now, for example, It is 31st March 2021. I have offense committed under 276 BB for financial year 13-14, and it has already been compounded. Status is nothing. Since it has already been compounded, we don't have to do anything. If compounding has already taken place under old provisions, we don't have to do anything. Now, on 20th December 2022, 276C, financial year 16-17, compounding is already done. Nothing, accepted, rejected, nothing. Since compounding is already done, we don't have to do anything. If compounding is already done, we don't have to do anything. Now, on 20th December 2023, 276 BB, offense is committed, and for financial 1920, it is compounding. Compounding is sought, but application has been rejected. Application has been rejected. Strange. Strange, sir, strange. On 20th December 2023, another 276 C compounding is sought for 1819 and application is pending. It has not been rejected yet. Remember, whenever there is an application which is pending, whenever there is an application which is pending, what would happen? A pending application shall continue. We don't have to do anything. Whatever the pending application is, that shall be first application under new regime, under new guidelines. We don't have to do anything to this pending application. We will be still given compounding as per new guidelines, but application does not to be filed if there is any application pending under old guidelines. Now, what would happen to this rejected application? If any application is rejected, can we go and seek compounding for this rejected application? Right answer is yes. If you want to go for compounding on this rejected application, you can still go. What the provision says? If you want to go to compounding, see this, they went, see, listen, they went. Now this is a new guidelines issued 12th December 2024. They have reapplied this guide, this rejected application. Financial year 1920, yes, same financial year, same offense, they have reapplied. Since they are reapplying, it is second time they are compounding this. They are reapplying under the same section. Provision says 1.2 times charges are to be paid. 1.2 times charges are to be paid. Now, on 20th December 2024, under 276 BB for 2021. Now, same offense. Offense is under same section, but here is different. So he is repeatedly doing the same offense now. Provision says for the same offense you are going for the third time now, so you have to pay 1.4 times charges. Now, on 24 December 2024, 276 BB for financial year 21-22. Again, same section, but fourth time he is going. Provision says since you are going for the fourth time, 1.6 times compounding charges you have to pay. After that, if assessee goes, for example, on 28th December 2024 for 275B, a new section altogether, in that case, if he is going for the first time, so normal compounding charges, whatever the compounding charges are given, would be considered. Listen, for example, if there are multiple directors in a company, director 1, director 2, director 3, if all of the three have been convicted, they can jointly also file an application for compounding. Although they have to pay charges separately, whatever the compounding charges are, they have to pay separately, but application can be filed jointly as well. Remember the best part of it, sir. For example, I have deducted TDS, but I have not paid to government. I have deducted TDS but not paid to government. Prosecution would be initiated against me. Provision is even before initiation of the prosecution, I can still pay compounding charges and get that sorted before initiation. I can pay compounding charges even before initiation of the prosecution. This is the important point. Come on to one of the question that is there in RTP. RTP September 25 MCQ number second. Now what this question is all about, we'll try to unfurl the intricacies of this question. You'll enjoy this. Timely Payments Limited is engaged in manufacturing and distribution of clocks and watches. Clocks and watches they distribute, got it. It has commenced multiple offences over different financial years. A detailed application made for compounding of such offences and the status is given below. Okay. Now listen, try understanding this. 10th Jan 2021, it is compounded. Section 276B, financial year 15-16. Since it is compounded, we have to ignore this. Since section is already compounded, we have to ignore this. 15th December 2022. Offense is compounded. Section 276(1), financial 1819. Do we have to do anything? Right answer is no, we don't have to do anything. We don't have to do anything. We don't have to do anything. Now, 14th September 2023. Application has been rejected. Now, offense is 276B and financial year is 1617 and rejected due to non-payment of taxes. Since it has been rejected, it will be reapplied. It can be reapplied. Okay. Now, on 20th September 2024, application was filed for 276CC, but it is not disposed of. So it is pending. What happens to pending application? What happens to pending application? Sir, pending application is the first application in the new guidelines. So do nothing. Eat 5-star, do nothing. Sir, what happens to this consolidated application? What happens to this consolidated application? Listen to this point very carefully. Consolidated application. What happens to this? Now, under new guidelines, SSC is going for consolidated application. Listen to this point very carefully. Huh? 15th November 2024, a consolidated application, fresh application covering offense under section 276B or 16. Oh, sir, this rejected application is going again for compounding in this fresh application. In this consolidated application, we are applying the rejected application. The application which was rejected earlier, we are seeking compounding again in this consolidated. Since we are going for the second time, whatever the compounding charges would be, we would be required to pay 1.2 times. Whatever the compounding charges are, we would be required to pay 1.2 times. Okay, sir. In the same consolidated application, offense under section 276C would be covered for financial year 2021. Now, in this case, normal compounding charges would be applicable, and offense under 275A would be applicable, is covered for financial year 2024. Again, so normal compounding charges would be applicable. Now, on 18th December 2024, a new application is filed, an application for offense under 276B. For the third time, he is committing offense under 276B. For the third time. First time was rejected. Second time reapplied. Third time again he is applying. So in that case, whatever the compounding charges are, he has to pay 1.4 times of that. And sir, prosecution initiated on 10th August 2023. Prosecution has been initiated on 10th August. And offense, compounding application has been made 18/12. 2024. See, after 12 months, he is seeking compounding. So, whatever the compounding charges are now, he has to pay 50% extra on that. So plus 50% extra will be the compounding charges. Let's see what the question is. All dues, including tax, interest, penalties, have been paid. Harsh. First thing they have paid. Whatever they were required to pay, taxes, penalties, they have paid. The application was filed necessarily undertaking to withdraw the appeals. Okay, they have withdrew the appeal. Done, sir. Compounding application of fees of 50,000, 25,000 were paid in single and consolidated. Oh God, they have also paid the fees, also application fees. So what they want from us? The company has delayed in depositing the TDS at source in the first quarter of financial year 24-25, 1 crore 25 lakh for 135 days. However, no prosecution had yet commenced. The company has paid all the TDS, interest and penalty, assuming that normal compounding charges is 45,000. Normal compounding charges 45,000. So compounding charges is 45,000 given in question. Normally, you will be given compounding charges always. Now, as per the guidelines of the compounding of the offences, how will the application dated 20th September 2020, 20th July 2024 would be treated? 20th July, 20th July, 20th July. See, 20th July is pending. If it is pending now, so it will be assumed as first application in the new guidelines. You don't have to do anything. Eat 5-star, do nothing. Eat 5-star and do nothing. It will be treated as debarred, wrong option. It will be disposed of, wrong option. It will be treated as first application, right option. Fourth option rejected automatically. Of course, option number C is the correct option. What is the rate of compounding charges applicable on the compounding of offence under 275A for financial year 23-24 included in consolidated application? Now, question is asking what is the compounding charges? This is the first time they are committing the offence now. So whatever the compounding charges are, they have to pay that only 45,000. Normal rate. Now, what rate of compounding charges shall be applicable on compounding of offence under 276B of financial year 16-17 included in consolidated application? Now, we are asking what is the compounding charges applicable on this 276B? Since we are going for the second time, the earlier application was rejected, so we are going for the second time. So, whatever the compounding charges are into 1.2 times would be considered. 1.2 times charges would be considered. Now, what would be the compounding charges for the application filed on 18th December 2024, offense 276B for financial year 23-24? Listen to this point very carefully. 18th December, fresh application. What will be the compounding charges? Since we are going for the third time, we have committed mistake for the third time. We have committed mistake for the third time. Listen. If we have mistake committed for the third time, whatever the compounding charges are into 1.4 times, that means 45,000 into 1.4 would imply 63,000. In addition to that, 50% extra would be charged since we are going after 12 months. So 14 for 50% is to be added. 94,500 is the compounding charges to be paid for this offense. 94,500 would are to be paid. Whether application for compounding offense can be filed for the third quarter. Now, what the point was, see, in quarter one, they have deducted TDS of 1.25 crore, but did not pay. They paid after 135 days. That means after in quarter number 3 they paid. Now, what is the issue? Whenever they pay this interest or late fees late, they have a risk of they have risk of prosecution now. So they already paid taxes. Already paid taxes. They have paid taxes. They have paid interest penalty. Now, can they pay compounding charges as well? Right answer is yes. You can seek compounding even if there is no prosecution initiated against you. So provision says yes, application can be compounded even no prosecution have been commenced. This is how our answer would turn out to be. Now, if I am asked summary about this entire compounding process, this is how summary would turn out to be. See, with effect from 17th October, how compounding takes place. Old provisions, old guidelines, whatever the offenses that have been compounded under old guidelines, you have to ignore such sections. Whatever the application that were pending in the old guidelines, treated as new application, nothing to be done. Whatever have been rejected now, new application to file in new guidelines. Whenever the new guidelines have come, what all the offenses are compoundable. Even rejected ones in the old guidelines can be reapplied. Now, if you have single offense, single application to be taken. If you have multiple offenses, then consolidated application, 25,000 fees or 50,000 fees is to be paid. What are the compounding charges per section wise? First time, if you are doing normal compounding charges given in question. Second time, 1.2. Third time, 1.4. Fourth time, 1.6, and so on. Where application was rejected in old guidelines and you want compounding in the new guidelines, then it would be treated as second application and 1.2 times charges are to be paid. If you want to go for compounding after 12 months of the prosecution, then 50% extra to be paid. Whatever the compounding charges are, 50% extra are to be paid. Who is going to compound CCIT, PCCIT, DCIT, PTCIT? If you have to pay compounding within 1 month from the end of the month of the order, but extensions are given. 6 month extension by competent authority, 6 to 12 months by CCIT, 12 months to 24 months CBDT, or more than 24 months. It is not allowed. You cannot get extra time than this. This is all about your compounding of offenses, or I must say amendments applicable for September 25 attempt. Everybody having anybody having any doubt? Shall we move on to amendments applicable for Jan 26? Shall we move on to amendments applicable to Jan 26? Yes, sir. Of course, you can move on. Now, what are the amendments? First of all, is if you remember, there was section 54 EC. If you had any long-term capital gain arising on account of immovable property or any kind of land or building, you could easily save 50 lakhs of capital gain if you invest in any of the bonds, any of NHAI bonds, any of the PFCL, IRFCL, these bonds. If you want to invest, you can invest and claim exemption. You had this option. You can invest there and claim exemption. In that list, now we had four bonds available. In that list, one more thing is added, that is HUDCO, Housing Urban Development Corporation. Another bonds of HUDCO has been introduced with effect from 1st April 2025. You can even invest in the bonds of the HUDCO to claim the exemption under 54 EC. Got it? Amendment and assessment procedure. So assessment procedure has undergone amendment. Array, we have already done this. What this point says, to 1st October 2024, you were allowed to quote Aadhaar number or enrollment ID. After the first 31st of after 1st October now 2024, you cannot quote enrollment ID. You cannot quote. But wherever you have already quoted now, you have to replace this enrollment ID up to 31st December 2025. You have to replace this enrollment ID to with actual Aadhaar. Now TDS TCS, sir, what amendments have taken place? See, sometimes what happens, you pay to some vendor. You pay some money to the vendor via UPI. Now your money has been deducted, but it does not receive to the vendor. It happens sometimes. Your money is deducted, but it is not received to the vendor. It happens. Many a times it happens. No, it happens because of technical glitches. Sooner or later, money is refunded back to you, but it did not reach to the vendor. This happens in case of TDS as well. You paid the TDS, you thought it is paid, but later on it got refunded. You did not notice, and because of which TDS amount is never reached to department. You think you have paid it, but it has not reached to department, because of which interest has started to pile up. Interest has started to pile up. It happens most oftenly that you pay because of technical glitch, it did not reach to department, and interest has started to pile up. Provision says you can get a waiver of that interest. Now, how can you get waiver of that interest? This is what the point is. Interest in delay of deposit of the TDS due to technical glitches can be waived provided that assessee has paid TDS amount in full and delay is not due to technical glitches but beyond the control of the assessee. If delay is not on account of assessee's mistake, this delay can be condoned, or this the interest can be waived off. Now, who will give waiver? CCIT, PCGIT, DGIT, PDGIT, these are going to give waiver. Whenever you want application for waiver, now you have to apply for the application within end of the 1 year. And sorry, whatever the year of order is, let that year end, and within 1 year you have to apply for waiver. Now, sometimes what happens is there are some assessees who pay the TDS, along with that by mistake they also pay the interest. They were not required to pay interest, but they even paid the interest. Can they get a refund of that? Provision says yes, they would get refund of that interest as well if you have paid the interest. But you were not supposed to pay now because by mistake this interest was paid. So provision says you can get even waiver of that interest as well. Certain amendments in tax audit. What are the amendments in tax audit? Listen carefully. Now, if you remember, there was a section called Section 43B. Now, what was this 43B? Let me take you through. 43B talked about expenses allowed on payment basis. There are certain expenses which were only allowed on payment basis. If you pay them, you will be getting deduction. If you did not pay, you will not get deduction. This is the entire gist. Now, under 43B, there were multiple sections: A, B, C, D, E, F, G, H. There were multiple clauses. For example, if you have any bonus expense, it will be only allowed if it is paid. Interest expense only allowed if it is paid. Similarly, we had 43BH, this last one, which is said that if you make any sum to MSME, if you pay any sum to MSME, it will be allowed only if you pay them up to the date specified in the agreement, if you remember. All these clauses were reported under clause 26 of tax audit report. All these things were reported under clause 26 of tax audit report. Now, this clause 23BH is not to be reported in clause 26, rather it is to be reported in clause number 22, that is amount paid to MSME and disallowed. You have to report this in this clause. You have to report this in this clause. That means under clause number 22, you have to report this. Got it? Got it? What reporting has to be done? See, whatever the amount that has been paid to MSMEs but disallowed, so you have to pay it late and disallowed, or whatever the things that were disallowed in last year but allowed in current year. These two things are to be reported under clause 22. Clause 26, it says now you don't have to report 43BH here, it would be reported in 22. Clause number 31, you can simply cut it down. Clause number 36B, what it says, see, if you have any kind of buyback happening, for example, if I have shares of a company and the shares are bought back, provision says whatever the money has been received has to be reported, and whatever the cost of acquisition is has to be reported. These two things are to be reported under newly inserted clause 36B. Now we have last amendments applicable for Jan 26. What are those amendments? Let's discuss it one by one. First of all, that is safe harbor rules. If you remember, in September attempt, government came up with certain safe harbor rules. That means one safe harbor rule was given. Any foreign company having any uncut, unassorted diamonds business in India, then uh, they would be liable to declare 4% as their PGBP. This was the case, if you remember. Today only we studied an hour ago. Now, in the same case, in the same case, in the same tone, multiple safe harbor rules have been introduced and that are exclusively applicable for Jan 26 and onwards, of course. So every safe harbor rule has to be learned. Now, what are those safe harbor rules? Let's discuss one by one. Understand this slowly. Huh? International transactions have to be considered. See, if any of the Indian entity provides software development services to non-resident associate enterprises, if any of the Indian entities provides software development to non-resident associate enterprises. Now, if the value of international transaction is up to 100 crore, they have to declare 17%. If their transaction value is up to 300 crore, then they have to declare 18% of their profits. And if their transaction exceeds 300 crore, then they don't have to declare anything. No safe harbor rules no safe harbor rules are allowed. See, safe harbor rules are nothing but like a presumptive taxation only. What is software development services like business application development? For example, if any foreign company requires application development, they want the software, so they hired Indian people. Support for existing system. Remember, research and development is not software development. Remember, research and development is not software development. So if international transaction is up to 100 crore, then 17%. International transaction is more than 100 crore, but up to 300 crore, then 18%. And more than 300 crore, no safe harbor. Now, of what 18% is to be taken? Normally in exam, what they do, operating profits upon operating costs. This is what they do. Operating profits upon operating costs. But if nothing is mentioned, you can use 17% of the transaction value or whatever the transaction price is. Operating profit upon operating cost, that is what they have to. That is what they do. No. In software development services, 17-18% you have to declare. 17% if transaction is up to 100 crore, 18% if transaction exceeds 100 crore, but up to 300 crore. No safe harbor if transaction exceeds more than 300 crore. Second safe harbor rules that are available are if any Indian company provides IT enabled services. IT enabled services. What are IT enabled services? Sir, any kind of back office operations, call centers, data processing, insurance processing, payroll, but does not include any research and development, educational content development, medical advice, and clinical trial. These things are not actually IT enabled services. Rest all things are IT enabled. Now, what happens when Indian entity provides IT enabled services to non-resident associate? Indian entity has to offer 17% as 17% as their income. If value exceeds 100 crore to 300 crore, then 18% is to be declared. And if transaction exceeds more than 300 crore, then no safe harbor rules are to be given. No safe harbor rules are allowed. Got it? Got it? ठीक है. Sir, got it. So, two activities we have done. Software development services, 17-18% we have to declare. IT enabled services, 17-18 we have to declare. Now, what is the third service? If Indian entity provides KPO services, knowledge process outsourcing services, KPO services if Indian entity is providing, then how much they have to declare? See, it depends upon if international transaction is more than 300 crore, then no safe harbor rule is given. But up to 300 crore, then safe harbor rules are given in this format. Employee cost to operating expense ratio, if it is more than 60% now, then 24%. If it is 40 to 60, then 21%, less than 40, then 18%. So if KPO services are provided now 24, 21, and 18, 24, 21, and 18, 24, 21, and 18, 24, 21, and 18, this is this amount of percentage that they have to declare. If their employee cost to operating expense ratio is more than 60%, then 24%. Employee cost to operating expenses 60 to 40, then 21%. Employee cost to operating costs is less than 40, then in that case it is 18% has to be declared. Now, what are KPO services? KPO implies HR services, engineering services, like big MBS people do not. These are these services. business analyst, financial analyst, market analyst, but research and development do not include. This is the third service. Can you all recall all the three? Can you all make me recall all the three? Can you all make me recall all the three activities? First of all, software development services 17, 18, 100, 300. IT enabled services 17, 18, 100 and 300. Now we have KPO services. KPO up to 300 we have safe harbor. Beyond that we don't have. Up to 300 we have 24, 21, 18. If employee cost to total operating cost is more than 60, then in that case 24%. 40 to 60, then in that case 21%. Less than 40, it is 18% they have to declare. Now what is the fourth safe harbor rule available? Again, if Indian entity provides any corporate guarantee to subsidiary. If Indian entity provides corporate guarantee to any of the subsidiary, here it is not just associate, it is subsidiary. If entity provides corporate guarantee to a subsidiary, listen, an amount of that corporate guarantee is up to 100 crore. Amount of that corporate guarantee is up to 100 crore, then 1% of the guarantee fees should be charged. At least whatever the guarantee is providing, now 1% fees should be charged. If Indian entity is providing any of the corporate guarantee to its subsidiary, then 1% fees should be charged if amount is up to 100 rupees, 100 crore rupees. But what if more than 100 crore guarantee has been given? More than 100%, provision says normally no safe harbor rules are allowed. If more than 100 crore guarantee you are providing to somebody now, then no safe harbor rules are allowed. But here is a catch. What if guarantee amount exceeds more than 100 crore? Guarantee amount exceeds more than 100 crore, then what do we do? Provision says if guarantee amount exceeds more than 100 crore now, then you have to check that whether to whom you have provided guarantee is of the highest standard rating from the entity that has been approved by the SEBI. That means, for example, you are providing guarantee to subsidiary. Now, that subsidiary should be of highest safety standard rating. With whom? With the SEBI registered agency. For example, SEBI has registered CRISIL, SEBI has registered ICRA. Now, these rating agencies should be rating that company, and that rating should be highest in that country. For example, if for example the Indian company is providing guarantee to somebody in Australia. Now, in Australia, double A rated is the best rating possible. So, double A rating should be obtained from SEBI registered agencies. Then only more than 100 crore guarantee can be given, and safe harbor rules can be opted. Otherwise, safe harbor rules cannot be opted. Got it? Getting it? Whenever we provide corporate guarantee to some entities, then in that case, up to 100 crore, 1% fees is to be charged. If a corporate guarantee exceeds 100 crore, then normally no safe harbor rules are given. But if guarantee has been given to somebody who is of highest safety safety rating, as per SEBI registered rating agencies, then in that case, 1% fees is to be charged and you will still get safe harbor rules. What did I say? If amount is up to 100 crore, 1%, more than 100 crore, no rating, no safe harbors. But if amount exceeds 100 crore and the person to whom you have given guarantee is of the highest safety ratings from the SEBI registered rating agencies, then it would be, then safe harbor would be given, 1% has to be offered. What is meant by guarantee? Guarantee is explicit guarantee that I will pay in case of your default. It does not employ letter of comfort. It does not imply implicit guarantee. It does not imply performance guarantee. It explicitly means explicit guarantee. Now we did four things, four transactions. Try recalling four transactions. Try recalling four transactions. सबसे पहला, first of all, software development services 17, 18 we have to declare. Second, IT enabled services 17, 18 we have to declare 100, 300. Then we have KPO services up to 300, 24, 21, 18 has to be declared. In case of guarantee, 1% up to 100 crore, more than 100 crore, no corporate guarantee, no safe harbor available. But if person to whom guarantee has been given is of the highest safety standards as per SEBI registered agencies, then in that case, 1% fees is to be charged. Now, point number 5. What are the other safe harbor rules? Provision says if any of the Indian company provides contractual research and development services with respect to software development, or it provides contractual research and development relating to generic pharmaceutical medicines, in that case, what would happen? To 300 crore, 24% is to be declared. Beyond 300 crore, no safe harbor rules are allowed. I am providing this Indian entity is providing research and development for software development. Indian entity is providing research and development for the purpose of generic pharmaceutical medicine. Research and development, generic pharmaceutical medicine. Research and development, generic pharmaceutical medicine. To 300 crore, 24% is to be declared. Beyond beyond 300 crore, no safe harbor rules are allowed. No safe harbor rules are allowed. Sir, guys, just blindly follow sir's material guidance and video exemption. कहीं नहीं गई. Thank you, Rahul sir. So thank you so much, Shakti. Thank you so much. Shakti was one of the student who scored 70 plus marks. 70 plus marks in last attempt. And I'm not sure 71 or 74. I don't remember, but 70 plus marks he secured. So kudos to your effort, Shakti, and thank you so much for your graciousness. Acha, even you have come this far and you have not subscribed to the channel. You really don't want me to succeed now. You want me to cry. You want me to cry and still not subscribe. Do subscribe to the channel. Do like the video. If you have come to this far, do like and subscribe. Okay. Now, what we were talking? We were talking about if we are providing contractual research and development relating to software development or contractual research and development relating to medicine. In that case, if transaction value is up to 300 crore, then 24% is to be declared. If transaction value more than 300 crore, then no safe harbor rules are to be allowed. Now, what are the transactions on which safe harbor rules are given? Right now we have covered five. Right away, starting from first, software development 17, 18, 100, 300. IT enabled services 17, 18, 100, 300. Then we have, what was the third one? APO services. If transaction is up to 300 crore, then in that case you are given safe harbor rules 24, 21 and 18% respectively. 24, 21 and 18 respectively. Perfect. I know Shakti, and you have subscribed, but other people who are watching, I'm telling to them. Now, KPO services 24, 21, and 18. If employee cost to total expense ratio is more than 24%, more than 60%, then 24, 40 to 60, then 21, less than 40, then it is 18% we have to declare. Then we came on to corporate guarantee. If you provide guarantee to a non-resident associate entity, non-resident subsidiary, in that case, 1% fees is to be charged. If more than 100 crore guarantee you are giving, normally no safe harbor rules are given. But in case you are giving guarantee to somebody who is of highest safety standard rating with the SEBI registered agency, na, in that case 1% fees is to be charged. Then if you are providing contractual research and development services to for the purpose of software development, or if you are providing contractual research and development services for generic pharmaceutical medicine, in that case, if transaction is up to 300 crore, then 24% is to be declared. Now, if you are into, if Indian entity is into manufacturing and export of core auto components. What is core auto components? See, core auto components imply engines, engine parts, transmissions, suspension parts, braking, steering, lithium ion batteries. These are core auto components parts. If Indian entity is providing and manufacturing and exporting core auto component parts to non-resident associate enterprise, provision says it should declare a profit margin of 12%. 12% profit margin has to be declared if it is manufacturing and exporting the non-core auto component part. For example, the seat cover, the seat that it is making, or some very screwdrivers. These things, if they are making that, then in that case, this is non-core auto component parts. They have to declare 8.5%. They have to declare 8.5%. So core auto components 12%, non-core auto components 8.5%. They have to declare. This was the sixth operation. Now seventh, we have to wait for some time, and eighth, if Indian entity is providing low value adding services. That means if it does not involve any intangible asset to be used, only low value adding activities up to 10 crore, na, then no transfer pricing rule shall apply in that case. Now, remember, research and development, IT, ITS, BPO, KPO, sales, marketing, insurance, these are value adding services. Do not consider it non value adding. These are value adding services. Got it, Izzy? Got it, sir. Got it. So we have done 7 safe harbor rules. Can you all make me recall? Can you all make me recall 7 safe harbor rules? Can you all make me recall? Of course, sir, why not? Of course, sir, why not? First of all, safe harbor rule could start from the software development services. 17, 18% to be declared, 100, 300 crore is the limit. IT enabled services, 17, 18% to be declared, 100, 300% is the 100, 300 crore is the transaction. APO services up to 300, 24, 21 and 18. This has to be declared. In case of corporate guarantee, 1% fees up to 100 crore. Beyond 100 crore, normally no safe harbor rules. But if providing to the highest safety standard rating subsidiary, then in that case, 1%. Then contractual research and development for software development or contractual research and development for generic pharmaceutical medicine. If 300 crore transaction is up to, then 24% you have to declare. Beyond that, you cannot declare. If you are manufacturing and exporting the core auto components, then 12%. But if you are not manufacturing and exporting non-core auto components, then 8.5%. And if you are providing any non-value adding activities, non-value adding non-value add, providing any non-value adding activities to this associate, 10 crore, no transfer pricing provision shall apply. Got this point? Now we have to come to interest. It is very important and it is the most beautiful portion. Okay. Now what this interest is all about, try understanding this. If I have given loan to one of my entity, any of my associate, how much interest should I be charging from that entity? That is important. I have given loan to an entity, how much interest should I be getting? Listen, I have given loan, how much interest should I be getting? That is the safe harbor rules. Now, it completely depends upon which currency I have given the loan. For example, I am living in India and I have given loan to somebody in Singapore. Or for example, I have given this loan in England. Example, London. Now, if loan has been given in rupee, then SBI rate of interest on first April of previous year plus something has to be charged. Or if loan has been given in foreign currency, then London's lending rate as on 30th September of the previous year plus something has to be charged. Bottom line is this. Bottom line is this only. What did I say? What did I say? If I have given loan in rupees, then whatever the SBI rate is, SBI lending rate is on first April of previous year plus something is to be charged. And if I have given loan in, for example, to London in foreign currency, then whatever the foreign currency lending rate is of the London, that rate plus something is to be charged. Simple point. If given in rupees, then SBI rate of first April plus something. If given in other currency, then other currency lending rate plus something is to be charged. Now, what is that something? It completely depends upon the credit rating of that entity. Let me take you through. Now, for example, if loan has been given in foreign currency, for example, I have given to somebody who is into London and their lending rate is LIBOR. Example, lending rate is LIBOR. Understand this. For example, if my entire loan to every associate, every entity exceeds 250 crore, then how much I have to charge? I have to charge 1.53, 4.5 and 6. 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 You have to charge in this manner. You have to charge in this manner 1.5, 3, 4.5, and 6. This is the amount of interest that you should charge in addition to the LIBOR. That means that country's exchange rate, that country's lending rate. In addition to that, you have to charge. Now, what is that? If, for example, you have given money to somebody in London in foreign currency, then LIBOR plus the rating agencies. If that entity is rated into AAA, AA, single A, then 1.5% in addition to LIBOR. If it is triple B rated, then 3% in addition to LIBOR. If that entity is rated double B or single B, then 4.5% in addition to LIBOR. If that entity is C or D rated, now in that case 6% in addition to LIBOR. If your entire loan given exceeds 250 crore entire loan given exceeds 250 crore, then this much amount of interest you should be charging. That country's lending rate plus something, LIBOR plus 1.5 plus 3 plus 4.5 plus something. It completely depends upon the credit rating of that agency. Sir, what if the entire loan advance is less than 250 crore? Then what would happen? Then that country's exchange rate plus 1.5 plus 3 plus 4%. For all the B and C category ratings, we don't have 4.5 and 6. Entire has been reduced to 4%. So, what did I say? What did I say? Try repeating after me. If you have given loan in foreign currency and foreign currency is lending rate plus something, now what is that something? It depends upon how much loan you have given. If you have given loan exceeding 250 crore, then 1.5, 3, 4.5 and 6. But if loan given has been less than 250 crore now, then 1.5, 3 and 4 is the only rate you have to charge. Beyond LIBOR, that is what you have to charge. Sir, what about if you have given loan in rupees, then what would happen? What about if you have given loan in rupee, then what would happen? Provision says if you have given loan in rupee, now same thing. SBI lending rate plus 1.5, 3, 4.5 and 6. In addition to that, 0.25% extra premium is to be charged. 0.25% premium is extra to be charged. That means 1.75, 3.25, 4.5, 6.25. This is the same rating that you have to charge. In addition to that, 4.25 when there is no credit rating available and 100% advances up to total advances up to 100 crore. Then this is what the entire discussion is. What I'm saying, listen, try understanding this, try repeating after me. First of all, if you have given loan to somebody, first of all, first thing is to be check whether you have given this in rupees or in that foreign currency. If that loan has been given in foreign currency, you have to check whether you have given advances in totality, whether your total out, whether your advance amount exceeds 200 crore or up to 250 crore or up to 200 250 crore. If it exceeds 250 crore now, then that country's lending rate clubbed with 1.5%, 3%, 4.5%, or 6% depending upon credit rating of that entity. If the loan advance is up to 250 crore, then whatever the rate, whatever the lending rate is of that country, in addition to that 1.5% plus 3% plus 4% is to be added. Now, if that loan has been given in rupees, then in that case 1.25, 1.5, 3, 4.5 and 6% is to be added plus 0.25% premium extra is to be made. But if there is no credit available and if total advance is given in rupees up to 100 crore, then maximum 4.5 plus 4.25 is to be charged. This is the entire safe harbor rules for interest advanced. Now, I want you all to recall this at least one time with me. I am talking about every safe harbor rule that we have studied. Right away from first to eight, all these safe harbor rules we have to study, we have to recall. First of all, we started with software development services. If software development services were given by Indian entity to non-resident associate, 17% up to 100 crore of transaction, 18% up to 300 crore of transaction. Beyond that, no safe harbor allowed. Second, IT enabled services. 200 crore 17%, beyond 100 crore up to 300 crore 18%, beyond 300 crore no safe harbor allowed. Third thing, KPO services. If Indian entity provides KPO to non-resident associate, then what would happen? Up to 300 safe harbor allowed, beyond that it is not allowed. Up to 300, how much it is allowed? Provisional says up to 300 only. How much it should be allowed? Listen, how much it should be allowed? 24%, 21%, 18%, depending upon employee cost upon total expense ratio. If it is more than 60%, then 24% is to be offered. If it is more than 40 up to 60, then in that case, 21%. If it is less than 40, then it is 18%. Then we talked about corporate guarantee. If we are providing corporate guarantee to any non-resident associate enterprise, non-resident, not associate, but non-resident subsidiary, then 1% of the fees is to be charged. 200 crore of transaction. If transaction exceeds 100 crore, then no safe harbor normally allowed. But in one case, safe harbor would be given. If we are providing guarantee to somebody which is of the highest safety and highest safety ratings as per SEBI registered agencies, then 1% fees is to be charged. If we are providing fifth safe harbor, if we are providing contractual research and development with respect to software development, providing contractual research and development with respect to generic pharmaceutical medicines up to 300 crore, 24% can be offered. Beyond 300 crore, no safe harbor allowed. If we are manufacturing and exporting core auto components to non-resident associate, then 12% is to be declared. If we are manufacturing and exporting non-core manufacturing auto components, then in that case, 8.5% is to be declared. We are providing non-value adding activities, then no, up to 10 crore, no transfer pricing would apply. If we are given any loan to an outsider in foreign currency, an aggregate advance during the year has been more than 250 crore, then you have to charge lending rate prevailing in that country as on 30th September of the previous year plus 1.5, 3, 4.5 and 6% based on credit rating. If aggregate advances is up to 250 crore, then lending rate in that country plus 1.5% plus 3% or 4% as the case may be depending upon that country. If loan has been given in rupees, then SBI's lending rate as on 1st April of previous year plus 1.5, 3, 4.5 and 6 plus 2.5 plus 0.25% premium in addition to everything. But if advance has been up to 100 crore in rupees, in that case only 4.25% you have to charge. That is the entire topic. This is the entire safe harbor rules available. Now we have to complete the rules with notes with respect to safe harbor, and then we have to do the judicial updates. So this judicial updates we'll pick. Now listen, whenever you want to opt for safe harbor rules, one important thing, you have to file form 3 CFA. 3 CFA you have to file up to the date of ROI. Remember, to the due date of ROI you have to file. If you delay in ROI, you cannot opt for safe harbor rules. You cannot delay ROI. Remember. Once, for example, for previous year 24-25, you want to opt to safe harbor rules. Can you opt? Yes, sir, you can opt. But with that option, you have an option to opt for safe harbor rules for 3 consecutive years. For this year, for this year, for this year, all the 3 years, you can consecutively opt for safe harbor. You have this option for opting safe harbor for 3 consecutive years. If you want to, you can opt for 3 years altogether. If you don't want to, you can apply for each years individually. That's your call. Remember, whenever you opt for safe harbor rules, AO will examine whether you are into eligible business or not. Sometimes you might say you are into core auto manufacturing, but you are not actually core auto manufacturing now. So in that case, what would happen? AO would check whether you are eligible SSC or you are doing eligible transaction or not. Now, for example, if AO has any doubt with respect to any transaction, now what would he do? He would refer the case within 2 months to transfer pricing officer. Now, in this entire safe harbor rules, every reference is to be made within 2 months. An order is to pass within 2 months. If no order has been passed within 2 months, now it is valid safe harbor rules. No department officer can stop you from claiming. It will be a valid safe harbor rules. Now, if AO has any doubts, he can refer the case within 2 months to TPO. He can refer the case. TPO will check and examine the validity of the SSC. If he finds out that SSC is ineligible SSC or a transaction is ineligible or SSC has furnished to fail to furnish the documents or he has furnished incorrect documents, in that case his safe harbor rules would become invalid. Remember, whatever TPO thinks, he has to file the offer order within 2 months from the end of the month of the in which such option is in which such reference is received. TPO has to pass the order within 2 months. He has to pass the order within 2 months. If no order has been passed by the TPO, remember, no order has been passed by the TPO, it shall be deemed valid. Safe harbor rule shall be deemed valid. In addition to that, if TPO wants to pass any order, which is whatever order he wants to pass, she should give a reasonable opportunity of being heard to the SSC. For example, TPO passes an order which is not acceptable to SSC. What SSC can do? He can go to CIT. Am I saying CIT appeals? No, I'm not saying. I'm saying he can go to commissioner, and he can go to commissioner, and commissioner has to confirm, reject, or invalidate the order of the TPO within 2 months from the end which request is received. So what did I say? I said three things. Whenever I file 3 CFA, within 2 months, if AO is not able to determine, he will refer the case to TPO. In 2 months, TPO has to pass the order. If he does not pass the order, it will be valid safe harbor. If we are not satisfied with the TPO, we have to go to commissioner. Commissioner will again pass the order within 2 months. So everybody has to pass order within 2 months. If any of one fails to pass within 2 months, now we will have valid safe harbor rules. Nobody can object us from claiming safe harbor rules. Now, whenever we claim safe harbor rules, no benefit of 1%, 3% is given. Remember, 1%, 3%, 3% margin was given to us. While calculating the average arm's length price, if you remember, we had 1%, 3% cushion. So here no 1%, 3% benefit is given. Whenever we opt for safe harbor rules, we have to maintain books of accounts. We have to get audited under section 92E. Whenever we opt for safe harbor rules, we are never given an option for MAP. That means we cannot ask government of both the countries sit together and decide in our favor. Right answer is we cannot do it. We have no option of going to MAP. Last but the most important thing, for example, Rahul. Rahul provides services to entity located in, say for example, Dubai. And what services? Software development services. Now what the section says. As per safe harbor rules, I can declare 17% oblique 18%. This is the amount of profit I can declare. 17 or oblique 18% we can declare. Yes, we can declare this much amount. Got it. Vision says if you are providing services to somebody who is into tax haven country. Tax haven country means tax rate is lesser than 15%. Where tax rate is less than 15%, then safe harbor rules are not given to you, not allowed to you. If you are providing services to somebody who stays in tax haven country, then safe harbor rules are not allowed to you. In addition to that, if you are any entity providing services to a notified jurisdictional area, Again, no safe harbor rules are allowed to be. This is all about the safe harbor rules, entire amendments. Now, come on to judicial updates. Let's do judicial updates. We have eight judicial updates, eight judgments. Do we need to learn them? We just need to understand the provision. We don't need to learn any judgment. We just need to understand the gist of it. If you're able to recall, then well and good. I never force myself to learn even. I personally think that you do have sufficient material to cover, sufficient material to learn. So this is not the thing you should be learning. Yes, of course, if you are able to learn, well and good. If you are not able to learn, that's absolutely okay from my end. Now, what are the eight judgments that we have to study? First of all, TCIT versus ANR Jupiter Private Limited. What does this section says? For example, if there is a company, there is a company called Rahul Mehul Private Limited. Limited. Now, this company has a balance sheet and share capital of 1 crore. Share capital of 1 crore. Got it. This company has a share capital of 1 crore. Reserves and surplus of 9 crore. And total assets of 10 crore. Total assets of 10 crore this company has. Got it. This is the basic structure of the company. All of a sudden, what happened is company decided to reduce the share capital. Reduce share capital. Now, what does that reduction in share capital imply here? It does not imply reducing the paid up share capital. For example, earlier Rahul had 50 lakh shares or Mehul had 50 lakh shares. Rahul had 50 lakh shares. Mehul had 50 lakh shares. Both of them had 50 lakh shares. Company reduced the number of shares that every shareholder had. Every shareholder who had 100 share, 99 shares were cancelled and only one share was left. Company cancelled down the 99% shares. Why it wants to cancel? Because it wants to reduce the share capital. Company cancelled down. Now, in this way, what happened? Every shareholder who is a shareholder is a still shareholder with the same percentage. Even though my 50 lakh shares have been reduced to 50,000, Mehul's, what is this happening? This 50,000 has been, Mehul's 50,000 has been 50,000 only left. 50 lakh has been reduced to 50,000. Now we both hold the same percentage of shares. We both hold the same percentage in the company. The fact is, most of our shares are gone, most of our rights in the company are gone. We have been entitled to reduce share capital now. Provision says whether we will be given benefit of this, whether it is a capital loss happening in our hand. Provision says yes, it is a capital loss arising on the proportionate reduction in share capital. It is allowable loss. Whenever there is reduction in number of shares, we are not talking about reduction in share capital. Do not get confused between 222D. We are not talking about 222D. We are talking about reducing the number of shares. Percentage remains the same. The ownership number remains the same. But here, what we are getting, we are reducing the number of shares that are existing in the market. In that case, what would happen? It would be a capital loss in the hands of the shareholders, and they would be entitled to set it off from other incomes. Now, what is the other income? For example, we have with us DCIT traveler. Now, what this DCIT traveler is, try understanding this. For example, SSC filed the return of income on 29th August, 29th March 2025. But return was defective. Return was defective. This defect was corrected by SSC on 14th April 2025. Now, can you all help me out with the due date of scrutiny notice? Sir, whenever we file the return, let that financial year end, and within 3 months we can get scrutiny notice. We get scrutiny notice for a specific year if we file the return. If we file the return within 3 months from the end of the financial year of ROI, we get scrutiny notice. So, what is the due date of scrutiny notice? Sir, scrutiny notice can be received up to 30th June. This is the first case. Or we can still get scrutiny notice up to 30th June 2026. From which date shall we consider the date of scrutiny notice? From which date? From the date of actual return, or from the date on which the return has been corrected? From which date we should consider the date of scrutiny notice? What should be the date up to which we can get the notice? See, We are filing return on time, but return was defective now. So we corrected return late. Now, because of this late return, department is saying that scrutiny notice can be issued even up to 30th June 2026 also. Where the department is saying correct. Right answer is no. No. Whenever you check the time limit for the scrutiny notice, time limit has to be considered from the original return. If the return has been corrected, return has been defect has been corrected, it does not mean that I have filed a new return. Original return was this only, so due date is this only. This judgment came in case of Traveler Designers Limited, Supreme Court, DCIT. Now, whether limitation period for the notice under Section 143 shall be computed from the original date under 139.1 for the purpose of defect or for the purpose of defect under 139.9. Now, court said relates to original return under Section 139.1. Original return of the filing barred by the limitation, it is invalid, which means ultimately if you take the date of the original return, that shall be the valid. If you take the date from the defective return, it shall be invalid. So ultimately scrutiny notice should be sent from the date of the actual return, based on the date of actual return, not from the revised return, on the actual return basis. Now, third, Bank of Rajasthan. What this case involves, let me tell you. Now, for example, if bank has securities and these securities are held as a stock in trade. Now, how these securities are held as stock in trade? The bank regularly buys and sells the securities. Regularly buys and sells securities. Now, what happened? Let me tell you. Bank bought bonds. Bonds. No. These bonds pay interest on 31st December 2024, and bank bought these bonds on 31st March 2025. This bond was actually priced at 1,000 rupees, but since after 3 months they are buying, so some accrued interest was due. Accrued interest had been accrued, accrued interest had been outstanding, so they had to pay extra 25 rupees to acquire that bond. This is very common in case of bond transactions. Whenever you buy any bonds, na, whatever the interest that had been accrued till that day, you get that. Whatever the interest that had been accrued till that day, you get that. Done, sir? Yes, sir. Done. Okay. Now, what this bank was saying is 25 rupees extra that they have paid is a revenue expenditure and should be allowed. Extra money that the interest that they have paid to acquire the bond is the revenue expenditure. It should be allowed as expenditure. This is what the bank says. In this case, Supreme Court clearly stated that if you hold these securities as a stock in trade, if you hold these securities as stock in trade, then any interest paid for broken period is a revenue expenditure. That means this interest for broken period na is a revenue expenditure. But if you were holding these securities as STM basis, that means on a capital asset basis, then this 25 was not allowed as deduction. Then this 25 was not allowed as deduction. Remember, what did I say? If you hold them as a stock in trade, then any interest for the broken period would be allowed to you. But if you do not hold them, if you do not hold them as stock in trade, you hold them as capital asset, then it would not be allowed to you. Would be absolutely not allowed to you. Now, what this topic was, sir? Now, PCIT versus Adrian Technology Supreme Court. What this case was? Let me tell you. Now, for example, now I want to develop my teachings. Okay? Now, right now, I'm teaching you on YouTube. I wanted to do something very superior. I thought, why not to make a hologram and do something very superior? I mean, very superior thing I want to do. Like you will feel like somebody standing in front of you and teaching. This would give a lot of confidence to you. I mean, multiple things I had planned. Now, in that case, I tested, and I could not receive anything. Or whatever I was trying, it was getting obsolete. Everything was getting outdated. Whatever I was doing, I was incurring too much of expenditure in the technology, but technology was getting outdated. Provision says if you incur any expenditure on development of a software which subsequently become abandoned due to technological obsolescence, it is kind of lost to us. It is kind of loss to us. Provision says it is a kind of loss to us. Yes, it will be a business loss and it will be allowed as deduction. So if you invest in any kind of technology which subsequently become outdated because of obsolescence, because of any other things, in that case you are allowed losses of that. You are allowed losses of that. It is not intangible asset, it is allowed loss. Now we have with us Johnson Matthey PLC versus CIT International Taxation. What does it mean? See, what does this case law was all about? Let me tell you. Now, for example, there is a foreign company and this is Indian company. Foreign company and Indian company are associates now. Not actually associates, but foreign company and Indian company are subsidiaries, parent subsidiaries. This is parent and this is subsidiary. Now, what the difference, what the transaction was all about, understand. Now, Indian company wants loan from a bank. Now, loan was given from a bank, but guarantee was given by this foreign company. Of course, it's subsidiary. Now, guarantee was given by this. Now, on this guarantee, now Indian company paid guarantee fees. Guarantee fees was paid by the Indian entity. Guarantee fees was paid by the Indian entity. So income tax department said this guarantee fees is nothing but interest and this is taxable in India. Oh dear God. Oh dear God. What does this point is talking about? If I am paying a guarantee fees to my associate, this is an interest payment. Department is saying if you are paying guarantee fees to your associate to your subsidiary, it is interest payment. Arey Baba, what they are talking. Of course, when I repay this loan, 94B provisions would apply. That is different matter altogether. That is altogether a different matter. My concern is if Indian entity is paying guarantee fees to its non-resident subsidiary parent entity, it does not amount to interest. And this was said in case of Johnson Matthey PLC in case of Delhi High Court. Now, what was this IBS Softwares versus Union of Kerala? What does this case law was? This was also a good case. Now, for example, this was draft order. There was a draft order. Okay. 144 seat was case. See, in case of DRP, whenever there was a draft order in case of non-resident or foreign company, this draft order was to be sent to assessee. Assessee has an option to either accept or ignore, or he can also object. He can object also. Now, to whom objection is to be made? Objection is made to DRP. Now, what DRP does? DRP issues guidelines to AO. DRP issues guidelines, and these guidelines are issued. These guidelines are issued within 9 months. Yes. As soon as guidelines are received by the AO has to pass order within 1 month. Within 1 month from end of month of guidelines, he has to pass. What got the basics? Section 144C mandates assessee or gives a choice to assessee to either object. He can object to DRP and DRP will issue guidelines in 9 months. Now, whatever the guidelines DRP is issuing, AO has to pass order within 1 month. He has to pass order within 1 month. What if AO delays? What if AO cannot pass the order? What would happen? Provision says if AO cannot pass the order within 1 month, now what would happen? It would be invalid. Invalid order. If AO cannot pass the order within 1 month, it would be invalid order. This is what the point is. Court held that time limit prescribed under 144C is mandatory and not directory. It is mandatory time limit. Within 1 month, he has to pass the order based on the guidelines. Provisions were enacted for speedy resolution of the transfer pricing. Any assessment order passed beyond the prescribed limit is invalid and void ab initio. Now, Frontiers Information Technology. This was a good case. For example, I have outstanding loan. For example, I have loan outstanding of 10 lakh rupees. And interest outstanding is 5 lakh rupees. Normally, whenever I don't pay any interest, it is disallowed. If you remember, it is disallowed under 43B. If I don't pay any interest, it is disallowed. What are the options available to me? What I did, I converted this interest to new loan. Does this amount to payment? Provision is asking if you convert your outstanding interest into a new loan, does this amount to payment? Right answer is no. If you convert your outstanding loan into interest, if you convert your outstanding interest into a new loan, it does not amount to payment. Right? If you pay this loan, it is allowed. If you pay this loan, it is allowed. It is allowed interest. Sir, what if you convert this interest portion into equity shares of a company? Does this amount to payment? If you have outstanding interest, it was disallowed, but you converted this interest into equity shares. Is this allowed? Earlier, When our outstanding interest was converted into loan, we had an obligation to pay now. We had an obligation to pay. If we did not pay, it was not allowed to us. But right now, do we have an obligation to pay? Right answer is no, we do not have an obligation. We do not have any obligation to pay. We have converted them into equity shares. So provision says this is an allowed expenditure. If you convert your interest into equity shares of a company, now it is allowed expenditure. It is absolutely allowed expenditure. And we had a question in on this topic. We had a question on this topic in RTP. In case of Nova Motions, I guess it was PGP question where the same adjustment was asked, where interest outstanding was converted into equity shares and it was allowed expenditure. Now we have Jindal Tractable Powers Company. Now this what was the case? Let me tell you. I have already written here. Now, what the case was? See, for example, this is Rahul. Okay. Now, Rahul has to make payment to somebody and he is dicey whether to deduct TDS under section 194C or 194J. Even if you have not subscribed to channel right now, you still have an option to subscribe to the channel. Listen, 194C or 194J, you are dicey. Which section to choose? Rahul is dicey, so he went to, say, for example, Deloitte. He went to Deloitte to take the professional opinion as to which section to be deducted. Now, Deloitte says, "Arey Rahul, why are you worrying? I am saying now say 196, say 194C. It's okay to deduct under 194C." I deducted. Assessing officer objected. Assessing officer said 194J. Assessing officer charged TDS at the rate of 9%. Whatever the differential amount was, I deducted 1%. Assessing officer wanted 10%. So 9% TDS was charged by AO. Plus interest was also charged by AO. Plus penalty under section 271C was also charged by AO because I deducted TDS of lesser amount. I did this and this wrong things. Now just tell me, just think of from my point of view. I relied on Deloitte, yeah, biggest consultancy firm in the world, biggest auditors in the world. I relied on the report of the Deloitte for this purpose, and Deloitte gave me this advice. Now what should I do? If I don't understand income tax, I relied on a professional opinion, and the professional opinion didn't turn well. Then what should I do? See, first of all, do not think of it in that way that we can go to appeal. Do not think it in that way. We can go to appeal, we can fight to, oh no, it's not the case. It is proven that 194J is applicable, but your opinion was wrong on the basis of a chartered accountant's report or on the basis of any uh, lawyer firm or on the basis of professional opinion. You got a wrong opinion. What would you do in that case? It is the immunity given under this case. Provision says, of course, TDS would be taken from you. TDS would be recovered from you because you are wrong. You were wrong. Of course, interest would be charged because you paid lesser amount, but penalty would not be charged because you had a reasonable cause of doing wrong. Now I have a reason because I relied on a Deloitte's report. In that case, I did some mistake. In that case, provision says I have been given an immunity. This is an immunity that no penalty would be charged because this is a reasonable cause now. So penalty would not be charged. This is what the judgment is all about. Whether reliance on a professional or legal chartered accountant report constitute a reasonable cause of failure for non-deduction of TDS. Right answer is bona fide professional advice. It is a reasonable cause. Mala it should no mala accordingly penalty would not be leviable. If there is not a mala intention, then in that case it is valid. This completes your entire judicial updates, statutory updates, all the circulars, all these updates, all the notifications, all the updates as the Finance Act, and these were very, very important for your exam. Thank you so much, guys, for coming up to this end. Thank you so much for listening up to this point. If you have any doubt, do let me know in the comment section. If you like this video even a bit, do mind sharing it with your friends. Do sharing it with your friends, and do drop a comment in the comment box manifesting that I will clear my CA final in this Jan 26 attempt. Because when manifestations turn reality now, I mean experience becomes surreal. So do manifest in the comment box that I will clear in this Jan 26 attempt. If you feel like if you want any more content in English, do let me know. I will be more than happy to make. Of course, things are not easy taking the session in morning, taking the section in afternoon. Speaking for 6 years in a row without a break, it is not easy. But still, because of you all, it is possible. So thank you, thank you so much. Bye bye. Take care. Have a great time. Have a great day. And of course, do comment down your experience. How was your experience in this session? Signing off. See you, Rahul Satija.